Understanding Wall Street is in many ways an investment in your own financial literacy. The more familiar you are with how capital markets evolved, the more likely you are to make sense of economic news, recognize patterns in market behavior, and understand the forces shaping modern finance. This knowledge becomes particularly useful when trying to navigate the steady stream of information about interest rates, market volatility, regulatory changes, and the ever-shifting landscape of global capital. Eventually, of course, every investor experiences both prosperity and loss. At some point, markets will turn, and when they do, having some insight into financial history can make you a more competent investor, citizen, or simply an informed observer of economic life. Now, Wall Street is not a simple institution. It's a complex ecosystem composed of traders, which cluster into firms, which in turn form markets, which are organized into a financial system. For the system to function properly, these components must not only operate effectively in their own right, but also coordinate with one another. Many institutions wear more than one hat, contributing to multiple functions depending on their unique capabilities. Most people are more familiar with the institutional level of financial organization, since this is where so many of our everyday economic experiences take place. You might hear about a bank failure, witness a market crash, or read about someone making or losing a fortune in stocks. Each of these events is associated with a particular institution or market, highlighting just how much our sense of economic stability and crisis is tied to these structures. Wall Street, fundamentally, is both a physical location and a metaphor. The actual street in Lower Manhattan, extending from Broadway to South Street, has housed financial institutions since the 18th century. When several institutions join forces to perform related functions, they form a market system. These systems carry out broader economic roles. For instance, there's the capital market, composed of stock exchanges, bond markets, investment banks, and brokers, all coordinating to allocate capital and enable price discovery. Though we won't trouble ourselves with exhaustive lists, you should know that each system includes specific institutions tailored to its particular functions. In this discussion, we've organized Wall Street's history into distinct eras, those dominated by speculation, those shaped by crisis, and those defined by regulation. These aren't rigid classifications, more like a helpful filing system for understanding centuries of financial evolution. Take the Gilded Age, for example. It has been placed in the speculation category because it featured unprecedented market manipulation and wealth concentration. But it's also a period of genuine industrial financing, channeling capital to railroads and factories. The takeaway here is not to get too hung up on which box an era gets placed in. In reality, just as institutions collaborate within markets, historical periods interact constantly with one another. Every aspect of financial history, from individual trades to systemic crises, is interconnected. We often study these eras in isolation, examining specific crashes or booms, analysing particular innovations or regulations. But none of them occurred in a vacuum. Consider the panic of 1907. This banking crisis altered the structure of American finance, but the consequences rippled forward. The Federal Reserve was created, banking practices changed, the regulatory framework evolved. Market psychology shifted, sometimes leading to caution decades later, sometimes forgotten in the next speculative mania. Financial history does not compartmentalize the way our chronologies might. Even the simple act of assigning an event to a specific era can feel slightly artificial. Most crises have roots in multiple periods. The 1929 crash emerged from 1920 speculation, but also from structural weaknesses inherited from earlier decades. So while we use these eras and categories to navigate the landscape of American financial history, it's wise to remember that in the end, everything is connected. Each era of Wall Street history carries out specific economic functions, and for the sake of study, they're typically examined one at a time. But in real life, they do not operate in isolation. Rather, they form a sort of financial continuum, with each period's innovations, regulations, and crises shaping the conditions for what follows. Markets respond to previous crises by creating new structures, which eventually become the source of the next crisis. Speculation leads to panic, panic leads to regulation, regulation leads to innovation, and innovation enables new forms of speculation. This pattern, if nothing else, has remained remarkably consistent. The market is, if nothing else, a master of adaptation. It survives crashes that seem terminal, absorbs regulations that appear crippling, and finds new ways to allocate capital no matter the constraints. The question is not whether Wall Street will endure, history suggests it will, but rather what form it takes and who benefits from that evolution. The origins of American capital markets can be traced to a time long before Wall Street had that name, to colonial merchants trading commodities beneath buttonwood trees and conducting business in coffee houses where the line between commerce and speculation had not yet been drawn. The financial markets of colonial America began not with stocks or bonds, but with commodities. Tobacco, furs, and grain changed hands in informal markets scattered across port cities, each transaction building the foundation for what would eventually become the world's largest capital market. These early exchanges bore little resemblance to the sophisticated financial system that would emerge, yet they established patterns that persist today. The gathering of buyers and sellers in specific locations, the negotiation of prices through competition, and the extension of credit to facilitate commerce. New Amsterdam, founded by the Dutch West India Company in 1624, was from its inception a commercial enterprise. The settlement existed to extract profit from the fur trade and to serve as a staging point for Dutch mercantile ambitions. The company maintained a trading post at the southern tip of Manhattan, and merchants conducted business in whatever spaces were available: taverns, docks, and open streets. In 1653, faced with threats from Native American tribes and rival European powers, the colonial government constructed a wooden stockade along the northern edge of the settlement. This defensive wall, running roughly east to west across the island, gave its name to the street that would later become synonymous with American finance, though the wall itself was demolished in 1699. When the British seized the colony in 1664, renaming it New York, the commercial culture persisted. Dutch merchants remained, British traders arrived, and the settlement continued its primary function as a port for transatlantic trade. The population grew slowly, from approximately 1,500 at the time of the British takeover to perhaps 5,000 by 1700. These residents engaged primarily in commodity trading, maritime commerce, and the various support industries required by a port city: shipbuilding, warehousing, and provision of supplies. Coffee houses emerged as central institutions in this commercial ecosystem. These establishments served multiple functions, providing refreshment certainly, but more importantly offering spaces where merchants could gather, exchange information, and conduct transactions. The practice had precedents in London and Amsterdam, where coffee houses had become informal centres of business activity. In New York, the Merchants' Coffee House, established in the early 1700s near the corner of Wall Street and Water Street, became a focal point for maritime insurance, commodity contracts, and the occasional sale of shares in merchant vessels or trading expeditions. Securities, in the modern sense, barely existed. What circulated were claims on specific cargoes, shares in particular voyages, and informal credit arrangements between merchants. A trader might purchase a share in a ship's expedition to the Caribbean, entitled to a portion of the profits if the venture succeeded. These arrangements were highly specific, difficult to transfer, and dependent on personal relationships. There was no secondary market to speak of. An investment was typically held until the underlying venture succeeded or failed. The American Revolution altered this landscape dramatically, though not immediately, in ways that favoured market development. The Continental Congress and various state governments issued paper currency and bonds to finance the war effort, creating a sudden abundance of securities. The problem was that these instruments were of dubious value. Continental currency depreciated rapidly, giving rise to the expression "not worth a continental." Government bonds traded at steep discounts, if they traded at all, as investors doubted the new nation's ability to repay its debts. After the war ended in 1783, these securities remained in circulation, trading in informal markets at fractions of their face value. Speculators accumulated them, betting that the new federal government might eventually honour the obligations. Meanwhile, merchants continued to use coffeehouses for business. The Tontine Coffee House, constructed in 1792 at the corner of Wall Street and Water Street, was financed through a tontine, a financial arrangement in which subscribers contributed capital and received returns based on the longevity of the group. The last surviving subscriber would collect the entire pool. The building itself became a hub for commercial activity, housing not just the coffeehouse, but also insurance offices and space for trading. Alexander Hamilton's appointment as the first Secretary of the Treasury in 1789 proved transformative for American securities markets. Hamilton believed that establishing public credit was essential to the nation's economic development. He proposed that the federal government assume state debts from the Revolutionary War and issue new bonds to replace the old, depreciated securities. This assumption plan was politically controversial. Some states had already paid their debts and saw no reason to subsidize those that had not. But Hamilton eventually secured passage through a compromise that moved the nation's capital to a site on the Potomac River. The assumption of approximately $75 million in federal and state debt created a substantial volume of tradable securities. These bonds, backed by the federal government's taxing authority, were far more credible than continental currency had been. They paid interest in hard currency and had defined maturity dates. Suddenly, investors had securities worth holding and worth trading. The market for government bonds expanded rapidly. Hamilton went further. In 1791, he chartered the first Bank of the United States, a quasi-public institution capitalized at $10 million. The federal government owned 20% of the shares, with the remainder sold to private investors. The bank served as the government's fiscal agent, managed the money supply, and provided credit to support commercial activity. Its shares, like government bonds, were tradable securities. For the first time, investors could purchase equity in an institution that was neither a specific voyage nor a temporary venture, but rather an ongoing enterprise. Insurance companies and state-chartered banks followed. The Bank of New York, founded in 1784, was among the first. Others emerged in Philadelphia, Boston, and other commercial centers. Each offered shares to investors, creating a slowly expanding universe of securities. By 1792, perhaps 2 dozen distinct instruments traded regularly in New York, including federal bonds, Bank of the United States shares, Bank of New York shares, and stocks in several insurance companies. Trading occurred wherever buyers and sellers gathered. Auctioneers advertised sales of securities in newspapers, conducting business on street corners or in taverns. Individual dealers bought and sold on their own account, posting prices in coffee houses. There was no standardization. One auctioneer might conduct a sale at noon on Wall Street, another at 1 p.m. at the Tontine Coffee House. Prices varied depending on who was present and how aggressive the bidding became. Settlement practices were inconsistent. Some transactions required immediate payment, others allowed credit, and disputes over the terms of sales were common. The market, such as it was, lacked any formal organization, no central location, no rules governing who could trade, no standards for how transactions should be conducted. Information circulated slowly and unreliably. A buyer in New York might not know the price at which a security had traded in Philadelphia until days or weeks later. This inefficiency created opportunities for arbitrage, but it also hindered the development of liquid markets. By 1792, New York's population had grown to approximately 33,000, and the city had established itself as a commercial center rivaling Philadelphia and Boston. The volume of securities trading, while still modest by later standards, had reached a point where regular participants saw value in establishing some structure. The informal system worked after a fashion, but its inefficiencies were apparent to anyone who participated regularly. Prices fluctuated based on which auctioneer happened to be conducting a sale. Settlement was haphazard. The market needed coordination. This informal system, though functional, created inefficiencies that became increasingly problematic as trading volume grew. Prices varied wildly depending on which auctioneer conducted the sale. Settlement was unreliable, with disputes arising over the terms of transactions. Competition among dealers and auctioneers sometimes benefited buyers and sellers, but just as often it created confusion about the true market price of a security. The market needed structure, and in 1792, a small group of brokers decided to provide it. On May 17, 1792, 24 stockbrokers gathered beneath a buttonwood tree at 68 Wall Street. The Buttonwood Agreement, simply put, was a cartel. 24 brokers agreed to trade securities only among themselves and to charge fixed commission rates, effectively creating the first organized securities market in the United States. The agreement itself was brief, just 2 sentences covering the essential terms. The signatories pledged to give preference to each other in their dealings and to charge no less than 0.25% commission on all transactions. This minimum commission prevented price competition among the brokers and ensured that each would earn a predictable fee from their trading activity. The motivations behind the agreement were straightforward. Auctioneers had been undercutting broker commissions, conducting public sales that attracted buyers and sellers, but offered no particular advantage to the regular traders who made markets in securities. By banding together and refusing to participate in auctions, the brokers could force trading through their private network. It was anti-competitive by design, though the participants would have argued that creating a stable, organized market served the public interest by improving price discovery and ensuring reliable settlement. The original signatories included some of New York's most prominent merchants and traders. Leonard Bleecker, who had served in the Continental Army, was among them. So was Benjamin Mendez Seixas, a broker and auctioneer who had helped establish the Bank of New York. John Bush, Ephraim Hart, and Alexander Zuntz also signed. These were not outsiders or upstarts, but rather established figures in New York's commercial community, men whose reputations provided credibility to the nascent organization. Initially, the brokers met daily beneath the buttonwood tree on Wall Street, weather permitting. When conditions were unfavorable, they gathered at locations nearby. This outdoor arrangement lasted only a year. In 1793, the group relocated to the Tontine Coffee House, renting a room on the second floor. The move indoors provided shelter and privacy, allowing the brokers to conduct business away from the casual observers and competing auctioneers who might gather on the street. The Tontine became the center of securities trading in New York, though it remained an informal arrangement. There was no formal constitution, no written bylaws, simply an understanding among the participants about how business would be conducted. For the next 2 decades, the market operated under this loose framework. The number of participants expanded gradually, reaching approximately 75 active brokers by 1820. Securities volume grew as well. Federal bonds remained the primary instruments traded, but the list expanded to include shares in state-chartered banks, insurance companies, and canal projects. New York competed with Philadelphia and Boston for trading volume, with Philadelphia often claiming superiority due to its larger population and more established financial institutions. The New York brokers' advantage lay in their organization and the city's growing importance as a port. In 1817, the brokers formalized their arrangement by adopting a constitution and taking the name New York Stock and Exchange Board. This document established membership requirements, defined trading rules, and created a governance structure. Members would meet daily at a specified time, with a president calling out securities in sequence. Brokers would announce their bids and offers, and transactions would be recorded. The Constitution also set admission standards for new members, who had to be proposed by existing members and approved by a vote. An initiation fee was charged, creating a financial barrier that limited membership and preserved the exclusive character of the organization. The board operated on a call market basis. Each security was called in turn, members announced their interest in buying or selling, transactions were executed, and the president moved to the next security. This system ensured that all members had equal opportunity to participate in trades, though it was less efficient than continuous trading. A broker seeking to buy or sell between formal sessions had to negotiate privately, outside the organized market. Nevertheless, the structure provided transparency and reduced the information asymmetries that had plagued the earlier, completely informal market. Trading hours were limited. The call session typically lasted an hour or two, after which members dispersed to conduct other business. Many brokers maintained additional occupations as merchants, insurance agents, or bankers. The securities market, while growing, did not yet provide sufficient income for full-time specialization. Volume on most days involved dozens of transactions at most, not the hundreds or thousands that would characterize later eras. Not all securities trading occurred through the board. A parallel market existed on the street literally. Brokers who were not members of the board, along with those trading securities that did not meet the board's listing standards, conducted business outdoors. This curb exchange operated on Broad Street and other locations near the organized exchange. The distinction between the board and the curb was partly about respectability. Board members viewed themselves as more established and professional, but it was also about the types of securities traded. The board focused on government bonds and shares in established banks and insurance companies. The curb handled more speculative instruments, mining stocks, and securities of newer, less proven enterprises. The Erie Canal project, authorized by New York State in 1817 and completed in 1825, demonstrated the capital market's growing capacity to finance large-scale infrastructure. The canal, stretching 363 miles from Albany to Buffalo, required approximately $7 million in construction costs, an enormous sum for the era. The state issued bonds to raise the necessary funds, and these securities were actively traded in New York, Philadelphia, and Boston. The canal's success, both as an engineering project and as a financial investment, enhanced confidence in state-backed infrastructure bonds and established a template for future projects. Railroad securities began appearing in the 1830s, initially in small quantities. The Baltimore and Ohio Railroad, chartered in 1827, was among the first to issue publicly traded stock. The Mohawk and Hudson Railroad in New York followed. These early high-site railroads were short lines connecting specific cities or linking canals to towns not directly served by water transport. The securities market remained dominated by government bonds and bank stocks, but the presence of railroad shares signaled the beginning of a transformation that would accelerate dramatically after the Civil War. The Panic of 1837 provided the first major test of the organized market's resilience. The crisis had multiple causes, including reckless lending by state-chartered banks, speculation in Western land, and international factors stemming from British monetary policy. When credit tightened and banks began failing, securities prices collapsed. The board's trading volume fell sharply as investors scrambled to sell. Many banks whose shares had traded regularly ceased operations entirely, rendering their stock worthless. The panic demonstrated that organisation and rules could not prevent losses when underlying economic conditions deteriorated, but the board survived. Trading continued, even as prices fell, and the market's infrastructure remained intact. Recovery from the panic took years. Securities prices remained depressed through the early 1840s, and many investors who had participated in the speculative boom of the mid-1830s were ruined. The experience reinforced certain practices among the surviving brokers, including greater attention to the creditworthiness of issuers and a wariness of securities backed primarily by speculative land values. It did not, however, prevent future manias. Financial memory tends to be short. The telegraph's arrival in 1844 altered the dynamics of securities trading by enabling rapid communication between cities. Before the telegraph, price information travelled at the speed of messengers or mail, meaning that arbitrage opportunities could persist for days. A security might trade at different prices in New York and Philadelphia simply because buyers and sellers in each city lacked current information about conditions in the other. The telegraph compressed these delays to minutes. Brokers in New York could now learn almost immediately what prices prevailed in Philadelphia or Boston, and vice versa. This integration of markets reduced arbitrage opportunities but improved overall efficiency. By the 1850s, the New York Stock and Exchange Board had firmly established itself as the dominant securities market in the United States. Philadelphia's exchange continued to operate, as did Boston's, but trading volume and the number of securities listed increasingly favored New York. The city's population had grown to over 500,000, making it the nation's largest urban center. Its port handled more cargo than any other. Banks concentrated their operations there. The board reflected and reinforced this centrality. Membership in the board carried prestige and provided access to a lucrative business. The initiation fee had risen as the organization's value became apparent, and seats, as memberships came to be called, could be sold by departing members to newcomers. This practice created a market in exchange seats themselves, with prices fluctuating based on the expected profitability of securities trading. A seat might sell for several $1,000s, a substantial sum, but one that could be recovered through commission income over time. Listing standards had evolved as well. Securities traded on the board were now required to meet certain criteria regarding the issuer's capitalization and financial transparency. This did not mean that all listed securities were safe investments. The panic of 1837 had demonstrated otherwise, but it did establish a threshold below which securities were relegated to the curb or to private transactions. The distinction between listed and unlisted securities became meaningful to investors who viewed board-listed instruments as more reputable. By the 1850s, the board's trading sessions had become more formalized. The call market system persisted, but the number of securities called had expanded significantly. Government bonds, bank stocks, insurance companies, canal bonds, and a growing number of railroad securities appeared on the daily list. Trading volume had increased as well, with hundreds of transactions occurring during each session. The market was no longer a minor adjunct to other commercial activities, but rather a substantial business in its own right. Regional exchanges in Philadelphia, Boston, and Baltimore continue to operate, each serving local markets and maintaining their own listing standards and trading practices. Competition among these exchanges was real, but not cutthroat. Securities often traded in multiple locations, and arbitrageurs helped keep prices aligned. The emergence of New York as the dominant financial center did not eliminate these regional markets, but it did establish a hierarchy that would persist and intensify over the coming decades. The market had structure, rules, and growing legitimacy. What it lacked was industrial securities on a meaningful scale. Railroad shares existed but remained a small portion of total trading volume. Manufacturing companies, oil refineries, steel mills, and the other industrial enterprises that would come to dominate American capitalism had not yet issued publicly traded stock in significant quantities. That would change dramatically in the decades following the Civil War. The railroad boom of the post-Civil War era would transform Wall Street from a market for government bonds and bank stocks into an engine for financing industrial expansion. The Gilded Age on Wall Street was fundamentally about railroads. These capital-intensive enterprises required financing on a scale never before seen in American history, and the investment bankers who could raise such sums became the most powerful figures in the nation's economy. A single railroad might need tens of millions of dollars to construct hundreds of miles of track, purchase locomotives and rolling stock, and establish the infrastructure necessary for operation. No individual investor could provide capital on this scale. Banks were limited by their own capital bases and regulatory restrictions. The solution was to sell bonds and stocks to thousands of investors, pooling their capital into amounts sufficient for railroad construction. Railroad mileage in the United States expanded from approximately 30,000 miles in 1860 to 193,000 miles by 1900. This explosive growth required continuous access to capital markets, and Wall Street provided the mechanism for channeling savings into railroad securities. Investment banks emerged as intermediaries between railroad companies seeking capital and investors seeking returns. These banks underwrote bond and stock issues, purchasing securities from the railroads and reselling them to investors at a markup. The underwriting function involved risk. If the bank could not sell the securities, it would be stuck holding them, but it also provided substantial profits when issues were successful. Jay Cooke became the most prominent investment banker of the immediate post-war period through his role in financing the Union government during the Civil War. Cooke had developed innovative techniques for selling government bonds to middle-class Americans, advertising heavily and employing a network of agents to reach investors who had never previously purchased securities. After the war, he applied these methods to railroad financing, most notably for the Northern Pacific Railway. Cooke's firm underwrote Northern Pacific bonds and used its distribution network to sell them to investors across the country and in Europe. The railroad's ambitions proved too large even for Cooke's capabilities, and in 1873 his firm collapsed under the weight of unsold Northern Pacific securities, triggering a financial panic. J.P. Morgan, who had come to dominate investment banking, operated differently from Cooke. Morgan focused on relationships with wealthy investors and institutional clients, rather than mass marketing to retail buyers. His firm, J.P. Morgan & Company, acted as agent for European investors seeking American securities, giving Morgan access to vast pools of capital. When railroads needed financing, they turned to Morgan because he could place large blocks of securities with reliable buyers. This power gave Morgan influence over railroad management. He insisted on representation on boards of directors and demanded financial transparency and operational efficiency as conditions for providing capital. The robber barons, as they came to be called, were a different species from the bankers. These men, Cornelius Vanderbilt, Jay Gould, Jim Fisk, and others, sought control of railroads not merely for the income from operations, but for the opportunities to manipulate stock prices, extract assets, and profit from the strategic positioning of competing lines. Vanderbilt, who had made his fortune in steamships, moved into railroads in the 1860s, purchasing the New York and Harlem Railroad and eventually consolidating several lines into the New York Central system. His approach was relatively straightforward. He acquired control, improved operations, and extracted profits from legitimate business. Gould and Fisk operated with fewer scruples. The Erie War of 1868 demonstrated how far these battles could go. Vanderbilt sought to acquire the Erie Railroad, which competed with his New York Central for traffic between New York and the Great Lakes. Gould and Fisk, who controlled the Erie's board, resisted. When Vanderbilt began buying Erie stock, Gould and Fisk simply issued more shares, printing stock certificates as fast as Vanderbilt could purchase them. This stock watering diluted existing shareholders but prevented Vanderbilt from gaining control. Vanderbilt secured a court injunction to stop the issuance. Gould and Fisk found a different judge who authorized it. At one point, Gould and Fisk fled to New Jersey with the Erie's cash to escape arrest in New York. The conflict was resolved through bribery, with both sides paying legislators to secure favorable laws. Vanderbilt eventually abandoned his takeover attempt, accepting a payment from Gould and Fisk to compensate him for his losses. The Erie War was not about business strategy, but about who could manipulate the legal system more effectively. Gould and Fisk's next scheme was even more audacious. In 1869, they attempted to corner the gold market. Gold, which was not yet fixed in value relative to the dollar, traded actively as a commodity. Gould and Fisk began accumulating gold, driving up the price through their purchases. Their plan required that the US Treasury not sell gold from its reserves, which would increase supply and undermine the corner. Gould cultivated relationships with government officials, including President Grant's brother-in-law, to influence Treasury policy. The scheme initially worked. Gold prices rose from $130 to $160 per ounce as Gould and Fisk bought aggressively. Other traders, seeing the price rise, rushed to buy as well, amplifying the move. On September 24, 1869, Black Friday, the price spiked to $160 before the Treasury intervened, selling gold and breaking the corner. Prices collapsed, many traders were ruined, and Gould, who had quietly begun selling before the collapse, escaped with profits, while Fisk absorbed losses. The Panic of 1873 had deeper roots than any single manipulation. Railroad construction had proceeded beyond any reasonable projection of traffic demand. Companies had issued bonds based on optimistic assumptions about future revenues, and investors had purchased those bonds based on faith that American economic growth would continue indefinitely. When it became apparent that many railroads could not service their debts, confidence evaporated. Jay Cooke's failure on September 18, 1873, was both symptom and catalyst. His firm's collapse revealed the extent of overinvestment in the Northern Pacific and triggered a cascade of failures among banks and brokerages that had extended credit based on railroad securities. The New York Stock Exchange closed for 10 days, the first such closure in its history. When trading resumed, prices had fallen sharply and volume remained depressed for years. The depression that followed the panic lasted until 1879, with periodic recoveries and relapses. Many railroads entered bankruptcy, defaulted on bonds, and underwent reorganization. This created opportunities for investment bankers, particularly J.P. Morgan, who specialized in restructuring failed railroads. Morgan's approach, which came to be called Morganization, involved consolidating debt, issuing new securities in exchange for old, and installing professional management to improve operations. In exchange for this service, Morgan extracted fees and placed representatives on the reorganized company's board, giving his firm ongoing influence over operations. Morgan's reorganizations affected more than half of the nation's railroad mileage by 1900. His representatives sat on dozens of railroad boards, creating a web of interlocking relationships that concentrated control in relatively few hands. This consolidation reduced destructive competition among railroads and improved financial stability, but it also raised concerns about monopoly power and the influence of bankers over the industrial economy. Beyond railroads, the late 19th century saw the formation of industrial trusts combining previously separate companies into unified enterprises. John D. Rockefeller's Standard Oil Trust, created in 1882, consolidated the majority of American oil refining capacity under single ownership. Similar trusts formed in sugar, whiskey, lead, and other industries. These combinations required capital for acquisitions and expansion, and Wall Street provided the financing. Investment banks underwrote securities issues for the trusts, earning fees, and expanding the universe of industrial securities available to investors. The formation of US Steel in 1901 represented the apex of this consolidation. Morgan arranged for the merger of Andrew Carnegie's steel operations with several competing companies to create the first billion-dollar corporation. The financing involved issuing approximately $1.4 billion in stocks and bonds, much of which Morgan's syndicate placed with investors. Carnegie himself received roughly $480 million, primarily in bonds, making him the wealthiest individual in America. The scale of the transaction demonstrated both the capital market's capacity to finance enormous enterprises and Morgan's dominance of that market. The ticker tape, invented in 1867 by Edward Callahan, revolutionized information flow in securities markets. Before the ticker, price information spread slowly, communicated by messengers or displayed on chalkboards in brokerage offices. The ticker transmitted prices electrically to remote locations almost instantaneously. Brokers and investors could now monitor market movements in real time, even if they were not physically present on the exchange floor. This democratization of information reduced the advantages of physical proximity and enabled the expansion of brokerage networks to smaller cities and towns across the country. Ticker tape also accelerated trading activity. When investors could see prices changing moment to moment, they responded more quickly to news and price movements. This increased volume, but also increased volatility, as rapid reactions to information could amplify price swings. The ticker became a symbol of Wall Street itself, its rhythmic clicking and the paper tape spooling out with printed prices representing the relentless flow of capital through the market. Stock watering, simply put, was fraud. Railroad promoters and corporate insiders would issue stock far in excess of any reasonable valuation of assets or earning power. A railroad might be capitalized at $10 million when its actual construction costs and physical assets justified perhaps $5 million. The excess $5 million represented watered stock, shares issued with no underlying value. Insiders who received this stock at little or no cost could sell it to unsuspecting investors at inflated prices. The practice was widespread, facilitated by weak disclosure requirements and the difficulty for ordinary investors to assess a company's true financial condition. Manipulation schemes varied. Pools of traders would coordinate to drive prices up or down, profiting from the moves they engineered. Insiders would spread false rumors to influence prices. Corners, where a trader attempted to control the entire supply of a security, occurred periodically, though most ended badly for the perpetrator. These activities were not illegal, securities regulation barely existed, but they contributed to public suspicion of Wall Street and to periodic calls for reform. Public participation in securities markets grew substantially during the Gilded Age, though it remained a minority activity. Perhaps 5 to 10% of American households owned stocks or bonds by 1900, concentrated among the wealthy and upper middle class. Brokerage offices expanded beyond New York and other financial centers, establishing presences in smaller cities. Middle-class investors, doctors, lawyers, merchants began purchasing securities, attracted by dividend yields that often exceeded returns available from bank deposits. This broader participation increased the political salience of market crashes and manipulation, as losses affected a wider constituency. The fortunes accumulated by the robber barons and investment bankers were unprecedented. Vanderbilt died in 1877 worth approximately $100 million. Rockefeller's wealth exceeded $300 million by 1900 and would eventually approach $1 billion. Morgan never disclosed his personal wealth, but his firm's capital and his control over vast pools of other people's money gave him power that arguably exceeded that of any individual based purely on personal fortune. These concentrations of wealth fueled populist resentment and political movements calling for antitrust enforcement and financial regulation. By 1900, American capital markets had been transformed. Investment bankers, particularly J.P. Morgan, wielded unprecedented power over industrial and railroad enterprises. Securities markets had expanded from trading primarily government bonds and bank stocks to encompassing railroads, industrial trusts, and a growing array of corporate securities. Trading volume had increased dramatically, facilitated by the ticker tape and the expansion of brokerage networks. The market's capital-raising function was undeniable, financing the railroads, factories, and infrastructure that enabled American economic growth. The concentration of power in so few hands troubled many observers, though. That tension between efficiency and democracy would shape the next major crisis. The system that had concentrated such power in the hands of private bankers would face its greatest test in 1907, when a single man's decisions would determine whether the American financial system survived. The Panic of 1907 began, as many financial crises do, with overconfidence. Trust companies, lightly regulated institutions that operated parallel to traditional banks, had fueled a speculative boom in copper stocks and real estate, lending freely against dubious collateral. These trusts had grown rapidly in the preceding decade, offering higher interest rates on deposits than banks could provide and investing in riskier assets to generate the returns necessary to support those rates. By 1907, trust companies held approximately $1 billion in deposits, a substantial portion of the financial system. The distinction between banks and trust companies mattered. Banks faced reserve requirements, restrictions on the types of loans they could make, and oversight from state or federal regulators. Trusts, originally chartered to manage estates and provide fiduciary services, had expanded into deposit-taking and lending with minimal regulatory constraints. They operated with lower reserves, made riskier loans, and maintained fewer liquid assets. This structure worked adequately during prosperous times, but created vulnerability when credit conditions tightened. The crisis's proximate cause was a failed attempt to corner United Copper stock. Otto Heinze and Charles Morse, speculators who controlled several banks and trust companies, believed that a group of short sellers had borrowed large quantities of United Copper shares to sell. If Heinze and Morse could gain control of the available supply, they could force the short sellers to purchase shares at inflated prices to cover their positions. The scheme required buying aggressively while preventing shares from reaching the market through other channels. In October 1907, Heinze began purchasing United Copper shares, driving the price from $39 to over $60 in a matter of days. The corner failed. More shares were available than Heinze had anticipated, either because his intelligence about short positions was wrong or because shareholders were willing to sell at elevated prices. When Heinze demanded delivery of the shares he believed were owed, the short sellers produced them without difficulty. The price collapsed to $10 within days. Heinze and Morse suffered substantial losses, but more significantly, their highly publicized failure raised questions about the solvency of the financial institutions they controlled. Depositors began withdrawing funds from banks associated with Heinze and Morse. These runs forced the banks to liquidate assets to raise cash, which they could do, though at losses. More problematic were the trust companies with which Heinze and Morse were affiliated. The Knickerbocker Trust Company, New York's third largest trust, had no direct connection to the Copper Corner, but its president, Charles Barney, was known to associate with Morse. Rumours circulated that Knickerbocker had exposure to the failed speculation. On October 22, 1907, depositors lined up outside Knickerbocker's offices demanding their money. The trust paid out approximately $8 million before suspending operations that afternoon. Its reserves were exhausted. The suspension sparked panic. If Knickerbocker, a large and supposedly respectable institution, could fail, perhaps other trusts were similarly vulnerable. Runs spread to other trust companies across New York. The Trust Company of America faced withdrawals of $13 million over 2 days. Smaller trusts suspended entirely. The panic's contagion extended beyond trust companies. Banks with correspondent relationships with the failing trusts faced deposit withdrawals. The stock market declined sharply as investors sold securities to raise cash. Brokers who had lent against stock collateral demanded additional margin or liquidated positions. Interest rates spiked as the demand for cash overwhelmed available supply. Overnight lending rates, normally around 6%, reached 100% and higher as desperate borrowers bid for funds. New York's financial community looked to J.P. Morgan, now 70 years old, but still the most powerful figure in American finance. Morgan had the relationships, credibility, and access to capital that might halt the panic. On the evening of October 22nd, Morgan convened a meeting at his library on Madison Avenue. He assembled the presidents of major banks and trust companies, along with Treasury Secretary George Cortelyou, who had traveled from Washington. The question was whether to rescue Knickerbocker and other failing institutions, or to let them collapse. Morgan decided to let Knickerbocker fail. The trust had been poorly managed, its president had resigned in disgrace, and Morgan judged that saving it would require too much capital with insufficient probability of success. Better to concentrate resources on institutions that might survive with assistance. The Trust Company of America, while facing severe withdrawals, had better management and sounder assets. Morgan organized a consortium of banks to provide loans keeping Trust Company of America solvent. Over the following days, Morgan orchestrated a series of interventions. When the New York Stock Exchange faced the possibility of closing due to lack of liquidity among member firms, Morgan arranged for $25 million in loans to prevent a closure that would have intensified the panic. When New York City could not roll over its short-term debt and faced potential bankruptcy, Morgan organized a syndicate to purchase city bonds. Each crisis was addressed through ad hoc arrangements, with Morgan determining which institutions would receive support and which would fail. The process required Morgan to assess balance sheets and business models under extreme time pressure, often with incomplete information. He worked from his library late into each night, summoning bankers and demanding commitments of capital. Those who resisted faced Morgan's displeasure and the implicit threat that their own institutions might be next to face runs. The system depended entirely on Morgan's judgment and his ability to coordinate collective action among institutions that were, in normal times, competitors. Treasury Secretary Cortelyou contributed government funds, depositing approximately $25 million in New York banks to increase reserves. This helped, but federal resources were limited. The Treasury was not a central bank and lacked authority to create money or lend freely. Its intervention was meaningful but insufficient on its own to halt the panic. By early November, the immediate crisis had passed. Trust companies that survived had stabilized, though many remained weak. The stock market had recovered partially from its lows. Credit markets remained tight, but the sense of impending collapse had receded. Morgan's interventions had worked, though at considerable cost. Knickerbocker and several smaller trusts had failed. Depositors suffered losses, and the economy entered a recession that persisted into 1908. The Panic of 1907 exposed fundamental weaknesses in American financial architecture. The absence of a lender of last resort meant that crisis management depended on private coordination, which in this instance meant J.P. Morgan. He was 70 years old. What would happen during the next crisis if Morgan were unavailable? The question was not hypothetical, it was inevitable. Political momentum for banking reform built quickly. The Aldrich-Vreeland Act of 1908 provided a temporary mechanism for banks to issue currency during emergencies, addressing one of the problems that had intensified the panic. More significantly, the Act created a National Monetary Commission to study banking systems and recommend reforms. Nelson Aldrich, a Republican senator from Rhode Island with close ties to Wall Street, chaired the commission. Aldrich led a delegation to Europe in 1908 to study central banking systems there. The group examined the Bank of England, the Banque de France, and the German Reichsbank, among others. Each operated differently, but shared certain features. They held reserves for the banking system, could issue currency, and acted as lenders of last resort during crises. Aldrich's commission concluded that the United States needed similar institutions. The political challenge was designing a central bank acceptable to American traditions of decentralized power and suspicion of concentrated financial authority. William Jennings Bryan and his populist followers feared Wall Street control of any central bank. Rural and Southern legislators worried that a New York-based institution would favor Eastern financial interests. Progressive Republicans wanted government oversight to prevent the kind of private manipulation that had characterized the Gilded Age. Aldrich proposed a National Reserve Association, a central bank with branches across the country, but ultimately controlled by bankers. The proposal died politically. Democrats and progressives rejected it as a banker's scheme. When Woodrow Wilson won the presidency in 1912, banking reform took a different direction. Carter Glass, a Democratic congressman from Virginia who chaired the House Banking Committee, drafted legislation creating a Federal Reserve System with meaningful government oversight. The Federal Reserve Act, signed into law on December 23, 1913, created a compromise structure reflecting competing political pressures. 12 regional Federal Reserve banks would operate in districts across the country, addressing concerns about New York dominance. Each regional bank would be owned by member banks in its district, but supervised by a Federal Reserve Board appointed by the President. The system could issue currency, hold reserves, and provide liquidity during crises. It was not a European-style central bank. No single institution held exclusive control, but it was far more than the completely decentralized system that had existed previously. The Federal Reserve structure deliberately fragmented power. The regional banks had independence in their operations, setting discount rates and deciding which institutions to lend to within their districts. The board in Washington provided coordination and could override regional decisions but lacked direct operational control. Member banks, required to join if they were nationally chartered and allowed to join if state-chartered, owned stock in their regional Fed but could not control it. The system's complexity reflected the political difficulty of creating any central authority in American banking. Whether this new institution would have the authority and will to use its powers remained uncertain. The Federal Reserve Act granted tools, the ability to issue currency, to lend to banks, to hold reserves, but did not mandate their use. Future crises would determine whether the Fed would act decisively or hesitate. That test would come catastrophically 16 years later. The 1920s would test the Federal Reserve's ability to manage a market boom unlike any in American history. The stock market boom of the 1920s represented, at first glance, a genuine democratization of American capitalism. Millions of middle-class Americans purchased stocks for the first time, often on borrowed money, convinced that prosperity was permanent and prices could only rise. Brokerage offices expanded from financial centres into small towns across the country. Newspapers printed daily stock tables. Investing became a topic of casual conversation, not just among wealthy elites, but among clerks, teachers, and shopkeepers who had never previously owned securities. The boom had legitimate foundations. American industrial capacity had expanded dramatically during World War I, and after a brief post-war recession in 1920-1921, the economy entered a sustained period of growth. Mass production techniques, pioneered by Henry Ford and others, reduced costs and expanded markets for automobiles, radios, refrigerators, and other consumer goods. Electrification spread through cities and into rural areas. Corporate profits rose steadily. The Dow Jones Industrial Average, which stood at approximately 64 in August 1921, climbed to 100 by 1924, reflecting genuine economic expansion. New industries created new investment opportunities. Radio Corporation of America, formed in 1919, embodied the technological optimism of the era. RCA manufactured radios and operated broadcasting stations, positioning itself at the center of a communications revolution. Its stock, which traded around $85 in early 1928, attracted investors who believed radio would transform American life. General Motors challenged Ford's dominance in automobiles, offering multiple models and annual styling changes. Utilities expanded rapidly, consolidating into holding companies that controlled electrical generation and distribution across multiple states. Each sector offered securities that seemed to promise participation in inevitable growth. The Federal Reserve, facing its first major test of managing a boom, sent conflicting signals. In 1927, responding to international pressures and a mild economic slowdown, the Fed reduced interest rates. This made borrowing cheaper and encouraged speculation. Some Fed officials, particularly those at the New York Fed, worried about stock market speculation and advocated tighter monetary policy. Others argued that the Fed's mandate was to support economic growth and employment, not to target stock prices. The institution's decentralized structure made coordinated policy difficult. Regional Fed banks set their own discount rates, subject to approval from the board, creating inconsistency across districts. Margin lending transformed stock investing from an activity requiring substantial capital into one accessible to those with modest savings. A buyer could purchase $1,000 in stock with as little as $100 down, borrowing the remainder from their broker. If the stock rose to $100, the investor could sell, repay the $900 loan, and keep $200, doubling their initial investment. This leverage amplified gains, but also created fragility. If the stock fell to $900, the broker would issue a margin call demanding additional funds. If the investor could not provide them, the broker would sell the stock, locking in the loss. Margin requirements, the percentage of a purchase price that buyers had to provide in cash, were set by individual brokers, not by regulation. Some required 50% margin, others accepted 20%, and the most aggressive allowed purchases with just 10% down. Brokers competed for customers by offering easier credit terms, creating a race to the bottom. By 1929, margin loans outstanding exceeded $8 billion, approximately 10% of the total value of stocks listed on the New York Stock Exchange. Investment trusts proliferated as vehicles for smaller investors to participate in diversified portfolios. These trusts, predecessors to modern mutual funds, sold shares to the public and used the proceeds to purchase securities. In theory, professional management and diversification reduced risk. In practice, many trusts were poorly managed, charged excessive fees, and engaged in self-dealing. Closed-end trusts, which issued a fixed number of shares that then traded on exchanges, often saw their share prices rise above the value of the underlying securities they held, a premium reflecting investor enthusiasm rather than rational valuation. More egregiously, investment trusts created pyramids by owning other investment trusts. A holding company trust might own shares in several operating trusts, which in turn owned stocks in operating companies. This structure amplified both gains and losses through the leverage at each level. Approximately 500 investment trusts existed in 1927. By 1929, that number had grown to nearly 800, with total assets exceeding $8 billion. The Goldman Sachs Trading Corporation, launched in 1928, exemplified the mania. Its shares initially sold for $104, rose to $326, and later collapsed to $1.75. Celebrity endorsements and popular enthusiasm fueled the speculation. Irving Fisher, a prominent Yale economist, declared in October 1929 that stock prices had reached a permanently high plateau. John J. Raskob, chairman of the Democratic National Committee and a General Motors executive, published an article titled "Everybody Ought to Be Rich," arguing that anyone who invested $50 per month in stocks would accumulate $80,000 over 20 years. Newspapers and magazines published profiles of ordinary Americans who had made fortunes in the market. The message was clear. Investing was not just for the wealthy, and those who failed to participate would miss the opportunity of a lifetime. RCA stock, which paid no dividend, rose from $85 to $570 between early 1928 and September 1929. The company's earnings did not justify this price by any traditional valuation method. Investors purchased RCA not for dividends or current earnings, but for anticipated future growth. This represented a shift in valuation logic. Traditional investors had focused on dividend yields and current earnings. Speculators in the 1920s focused on price appreciation, driven by the expectation that other investors would pay even more. As long as this expectation persisted, it became self-fulfilling. When it broke, the reversal was brutal. The Dow Jones Industrial Average reached 381.17 on September 3, 1929. This represented a gain of approximately 400% from the 1921 low. Trading volume had expanded enormously. Daily volume that exceeded 3 million shares was considered heavy in the early 1920s. By September 1929, daily volume regularly exceeded 5 million shares, with particularly active days reaching 6 or 7 million. The ticker tape, which transmitted prices from the exchange floor to brokerage offices, often ran hours behind the actual trading, creating confusion about current prices. Warning signs had appeared throughout 1929. Roger Babson, a financial statistician, predicted in September that a crash is coming and it may be terrific. The market declined sharply that day, September 5th, in what became known as the Babson break, but recovered within days. Bernard Baruch, a legendary speculator, had been reducing his stock holdings since early 1929, concerned that valuations had become unsustainable. Paul Warburg, a banker instrumental in creating the Federal Reserve, warned that speculation was reaching dangerous levels. These warnings were dismissed or ignored by those convinced that traditional rules no longer applied. The market weakened through September and early October, declining from its peak, but without the panic that would soon follow. On October 23, 1929, heavy selling emerged. The Dow fell 6.3% on high volume. Concern spread through the financial community, but many believed this was a healthy correction that would create buying opportunities. October 24, 1929, Black Thursday, opened with massive selling. Within the first hour, prices had fallen sharply across the board. The ticker tape fell behind by minutes, then hours, leaving investors uncertain about current prices and unable to assess their positions accurately. Margin calls flooded brokerage offices. Brokers liquidated positions when clients could not meet calls, adding to the selling pressure. By noon, panic had set in. a group of prominent bankers, including representatives from JP Morgan and Company, Chase National Bank, and National City Bank, met at the Morgan offices at 23 Wall Street. They organised a support operation, pooling funds to purchase stocks and stabilise prices. Richard Whitney, Vice President of the New York Stock Exchange and the Morgan firm's floor broker, entered the exchange floor and placed a highly visible bid for US steel at $205 above the current market price. The message was clear: organised support was arriving, prices stabilised and recovered some of the day's losses. The market closed with a decline, but the panic had been checked. Volume reached 12.9 million shares, a record. The weekend brought reassurances from business and political leaders. President Herbert Hoover stated that the nation's business was fundamentally sound. Economists noted that corporate earnings remained strong. Many believed the worst had passed. October 28th, Black Monday, shattered these hopes. Selling resumed immediately at the opening and intensified throughout the day. The Dow fell 13%. Volume reached 9.25 million shares. The organised support from Thursday did not reappear. The bankers had concluded that attempting to support the market against overwhelming selling pressure would exhaust their resources without effect. Better to preserve capital and let prices find their natural level. October 29th, Black Tuesday, brought catastrophe. Selling orders overwhelmed the exchange from the opening bell. Prices collapsed across the board as margin calls forced liquidation. Investors sold anything they could to raise cash. High-quality bonds and stocks fell alongside speculative issues. The Dow declined another 12%. Volume reached 16.4 million shares, a record that would stand for decades. The ticker tape ran hours behind, meaning that most investors selling during the day did not know the prices they were receiving. When the tape finally finished transmitting the day's trades after 7 p.m., the full extent of the losses became apparent. The human cost of Black Tuesday has been somewhat exaggerated in popular memory. Stories of investors jumping from buildings circulated widely, but documented suicides directly attributable to market losses were relatively few. The financial cost was undeniable. Billions of dollars in paper wealth had vanished. Margin loans that had seemed secure when stocks were rising became uncollectible when prices fell. Brokers faced losses from clients who had disappeared or declared bankruptcy. Investment trusts, leveraged heavily, saw their share prices collapse by 80 or 90% as the underlying securities they held declined. The crash did not end on Black Tuesday. Prices continued falling, with periodic rallies through November and into 1930. Each rally attracted buyers who believed they were purchasing stocks at bargain prices, only to see further declines. The Dow stabilized around 200 in late 1929, down nearly 50% from the September peak, but still above the levels of 1928. Many observers believed the worst had passed. It had not. The market declined through 1930, 1931, and into 1932. The Dow reached its ultimate low of 41.22 on July 8, 1932, representing a decline of 89% from the 1929 peak. RCA, which had traded at $570 in 1929, fell to $250. General Motors fell from $73 to $8. US Steel, which Richard Whitney had bid for at $205 in an attempt to stabilize the market, traded at $22. The crash's relationship to the Great Depression remains debated by economic historians. The market decline destroyed wealth and confidence, reducing consumption and investment. Bank failures, which accelerated after the crash as loans backed by securities went bad, contracted credit availability. International factors, including the gold standard and protectionist trade policies, contributed to the global economic collapse. The Federal Reserve's failure to provide adequate liquidity worsened the contraction. Assigning relative weights to these factors is difficult, but the crash undeniably contributed to and was amplified by the Depression. Investment trusts, which had proliferated during the boom, largely disappeared. Those that survived operated under clouds of scandal, and recrimination from investors who had lost everything. The investment trust structure itself became associated with fraud and speculation. When mutual funds later emerged under the Investment Company Act of 1940, they operated under strict regulations designed to prevent the abuses of the 1920s. The crash destroyed not just wealth, but confidence in the financial system itself. The Dow Jones would not return to its 1929 peak until November 1954, 25 years later. More immediately, the crash helped trigger the Great Depression, as collapsing asset prices led to bank failures, which led to credit contraction, which led to economic collapse. The market, having amplified the boom, now amplified the bust. Wall Street's reputation would not recover for decades. The financiers and brokers who had been celebrated as wizards during the boom were now vilified as charlatans who had led ordinary Americans to ruin. The regulatory framework that would eventually emerge from this disaster would fundamentally alter the relationship between markets and government. The Great Depression that followed the crash would reshape not just the economy, but the entire regulatory framework governing American capital markets. The regulatory architecture that governs American capital markets today was built overwhelmingly in a 4-year period from 1933 to 1936. These laws, crafted in the depths of the Depression, reflected a determination that the excesses of the 1920s would never recur. They created federal oversight where none had existed, imposed disclosure requirements on companies seeking capital, and separated commercial banking from investment banking in an attempt to prevent conflicts of interest that had contributed to the crash. The banking crisis preceded the regulatory response. From 1930 through 1933, approximately 9,000 banks failed, wiping out depositors' savings and contracting credit throughout the economy. Each failure created ripples. When a bank closed, its borrowers lost access to credit. Businesses that depended on those loans curtailed operations or closed entirely. Workers lost jobs. Depositors who lost savings reduced consumption. Other banks, seeing runs develop, hoarded reserves rather than lending, amplifying the credit contraction. The Federal Reserve, which had been created partly to prevent such cascades, proved ineffective. Regional Fed banks pursued conflicting policies, and the board lacked clear authority to impose coordination. By March 1933, when Franklin Roosevelt took office, the banking system was in collapse. Roosevelt's first act as president was to declare a national bank holiday, closing all banks while the administration and Congress crafted emergency legislation. The Emergency Banking Act, passed after a single day of debate, gave the president authority to regulate banking transactions, permitted the comptroller of the currency to reorganize insolvent banks, and provided Federal Reserve loans to sound institutions. Banks were examined, and those deemed solvent were permitted to reopen. The holiday halted the panic and bought time for more comprehensive reforms. While the banking system stabilized, attention turned to the securities markets and the practices that had enabled the 1920 speculation. Ferdinand Pecora, a former New York assistant district attorney, was appointed chief counsel to the Senate Banking Committee in January 1933. His mandate was to investigate the causes of the crash and the practices of banks and securities firms. Over the following 18 months, Pecora conducted hearings that exposed Wall Street's inner workings to public scrutiny. The hearings revealed systematic abuses. National City Bank, one of the nation's largest, had created a securities affiliate to underwrite and sell stocks and bonds. The bank made loans to customers to purchase those securities, creating conflicts of interest at every level. When securities declined in value, the bank absorbed losses while insiders profited. Charles Mitchell, National City's president, had sold stock to family members at a loss to avoid taxes, then repurchased it later, a transaction designed purely for tax evasion. Mitchell resigned during the hearings and later faced criminal charges for tax fraud. J.P. Morgan and Company, the most prestigious investment bank, maintained a preferred list of individuals to whom it offered securities at below-market prices. The list included government officials, corporate executives, and influential figures who might provide favourable treatment to Morgan's interests. This was not illegal, but it demonstrated how Wall Street operated through relationships and favours rather than transparent markets. Morgan Partners also acknowledged paying no income taxes in 1931 and 1932, having structured their affairs to generate losses that offset other income. Investment trusts had sold securities to the public while concealing their true financial condition and the fees they charged. Pool operations had manipulated stock prices through coordinated buying designed to attract unsuspecting investors. Short selling had been blamed for the crash, though Pecora's investigation found that shorts generally lost money during the decline, contrary to popular belief. The hearings provided compelling evidence that the securities markets had operated with insufficient transparency and excessive conflicts of interest. Congress responded with comprehensive legislation. The Securities Act of 1933, passed in May of that year, required companies offering securities for public sale to file registration statements with the Federal Trade Commission disclosing financial information, business operations, and risks. The Act imposed liability on issuers, underwriters, and directors for false or misleading statements, creating incentives for accurate disclosure. Securities could not be sold until the registration statement became effective, giving regulators time to review the information provided. Glass-Steagall, formerly titled the Banking Act of 1933 and passed in June, separated commercial banking from investment banking. Banks that accepted deposits could no longer underwrite or deal in securities. Investment banks that underwrote securities could not accept deposits. The law's architects believed that combining these functions created conflicts of interest and encouraged banks to make risky investments with depositors' funds. Commercial banks chose to exit securities activities rather than forfeit deposit taking. J.P. Morgan and Company became a commercial bank. Its investment banking operations were spun off into Morgan Stanley, a new firm created specifically to comply with Glass-Steagall. The Securities Exchange Act of 1934, passed in June, regulated secondary market trading. It created the Securities and Exchange Commission, a new federal agency with authority to oversee stock exchanges, broker-dealers, and the securities markets generally. The SEC absorbed the registration functions previously assigned to the FTC and gained broad rulemaking authority. The Act required companies with publicly traded securities to file periodic reports disclosing financial results. It prohibited manipulative practices, including wash sales, matched orders, and dissemination of false information to affect prices. It gave the Federal Reserve authority to set margin requirements, removing this function from individual brokers. Joseph P. Kennedy, a successful businessman and speculator who had reportedly made a fortune through various means, including stock pools, became the SEC's first chairman. Roosevelt's choice was controversial. Critics noted that Kennedy had participated in precisely the activities the SEC was created to prevent. Roosevelt reportedly replied that it took a thief to catch a thief. Kennedy served for 15 months, establishing the SEC's organizational structure and demonstrating that the agency would enforce the new laws aggressively. His appointment, however cynical the logic, provided credibility that someone familiar with Wall Street's practices was overseeing reform. Margin requirements, which brokers had set as low as 10% during the 1920s, were raised by Federal Reserve regulation to 50% and sometimes higher. This reduced leverage and limited the ability of speculators to control large positions with small amounts of capital. The restriction made speculation less profitable, but also reduced systemic fragility. When prices declined, margin calls were less likely to force cascading liquidations. The Investment Company Act of 1940 regulated mutual funds and other investment companies. It required registration, imposed restrictions on leverage and affiliated transactions, and mandated specific governance structures. Closed-end funds, which had been vehicles for abuse during the 1920s, could no longer issue multiple classes of securities with different rights. Open-end mutual funds, which issued and redeemed shares at net asset value, became the dominant structure. The Act's provisions ensured that investment companies operated transparently and in the interest of shareholders rather than insiders. These regulations fundamentally altered Wall Street's operations. The separation of commercial and investment banking reduced the concentration of financial power that had characterized the Morgan era. Disclosure requirements gave investors access to information previously available only to insiders. The SEC's enforcement actions demonstrated that securities fraud would face federal prosecution. The changes were resisted by many in the financial industry, who argued that regulation would reduce efficiency and limit capital formation. Experience suggested otherwise. The markets operated with greater transparency and stability under the new regime. Market performance through the 1930s remained poor despite regulatory reforms. The Dow Jones, which had reached 41 in 1932, recovered to 194 by early 1937, still far below the 1929 peak, but representing substantial gains from the low. A recession in 1937-1938, triggered partly by premature fiscal tightening, sent the market back down. The Dow fell to 98 in 1938 before recovering again. Throughout the decade, trading volume remained well below 1920s levels. Many Americans who had lost money in the crash stayed away from stocks permanently. World War II transformed the economic environment. Industrial production expanded dramatically to meet military demands. Unemployment, which had exceeded 20% during the worst years of the Depression, fell to negligible levels as factories operated at full capacity and millions entered military service. Corporate profits rose sharply. The stock market responded positively, though price controls and regulations limited speculation. The Dow closed 1945 at 192, only modestly above its 1937 level, but positioned for the post-war boom. The war also created pent-up savings. Consumer goods were scarce due to rationing and production priorities. Workers earned wages but had limited opportunities to spend. When the war ended and production shifted to consumer goods, this savings provided purchasing power that fueled economic expansion. Veterans returning from military service used GI Bill benefits to pursue education and purchase homes. A new middle class emerged, larger and more prosperous than before the Depression. The regulatory framework established in the 1930s shaped expectations about government's role in financial markets. Federal oversight was now accepted as necessary and permanent, a shift from the pre-Depression era when markets had operated with minimal regulation. The SEC, initially controversial, became an established part of the financial landscape. Glass-Steagall's separation of commercial and investment banking was viewed as essential to financial stability. These arrangements would remain largely intact for decades. By 1940, American capital markets operated under a regulatory regime that would remain largely intact for 60 years. The separation of commercial and investment banking, mandatory disclosure, and federal oversight became the foundation of the modern system. The market had been tamed, though whether permanently or temporarily remained to be seen. For now, the more pressing concern was war and then reconstruction. Wall Street's role would be to finance both. The post-war period would usher in an era of stability and prosperity that made the Depression seem like a distant nightmare. The American stock market from 1950 to 1980 accomplished something unprecedented. It created broad-based middle-class wealth. Pensions, mutual funds, and steady bull markets transformed millions of Americans from workers into investors, often without them actively choosing to participate. This represented a fundamental shift in how capital was accumulated and distributed. Previous generations had built wealth through business ownership, real estate, or saving. The post-war generation built it through equity ownership, mediated by institutions that pooled individual savings into large portfolios. The economic boom had solid foundations. Consumer demand, suppressed during the Depression and war years, surged. Veterans used GI Bill benefits to attend college and purchase homes, creating demand for construction, appliances, and automobiles. The suburbs expanded rapidly, requiring infrastructure investment. Television became commonplace, creating new industries in manufacturing and broadcasting. American corporations faced little international competition, as European and Japanese industries had been devastated by war. This combination of strong domestic demand and limited competition produced exceptional profit growth. Pension funds emerged as major participants in securities markets during this period. Defined benefit pensions, which promised retirees specific monthly payments based on years of service and salary, required substantial assets to fund future obligations. Corporate pension managers discovered that investing in stocks, despite short-term volatility, provided returns exceeding those available from bonds or cash. General Motors, US Steel, and other major corporations established pension funds that accumulated billions in assets. Union-negotiated pensions for auto workers, steel workers, and other industrial employees added to the total. By 1960, pension fund assets exceeded $50 billion. By 1980, the figure approached $500 billion. Mutual funds, regulated under the Investment Company Act of 1940, grew alongside pension funds. These funds offered small investors diversification and professional management at reasonable cost. The Massachusetts Investors Trust, founded in 1924 and one of the few investment companies to survive the Depression, expanded steadily. New funds launched regularly, each with different investment strategies. Growth funds focused on capital appreciation. Income funds emphasized dividend-paying stocks. Balanced funds held both stocks and bonds. By 1960, approximately 200 mutual funds managed $17 billion in assets. By 1980, those numbers had grown to over 500 funds, managing more than $100 billion. The stock market rose steadily through the 1950s. The Dow Jones Industrial Average crossed 200 in 1950, reached 500 by 1956, and approached 1,000 by the mid-1960s. This represented approximately five-fold growth over 15 years, a remarkable run sustained by genuine earnings growth and expanding valuation multiples. Dividend yields, which had exceeded 6% in the early 1950s, fell below 3% as investors became willing to accept lower current income in exchange for expected capital gains. The Depression generation's caution about stocks gradually gave way to confidence. The go-go years of the 1960s brought a speculative edge to the bull market. Aggressive growth funds, managed by young portfolio managers willing to take concentrated positions in smaller companies, attracted investor money with spectacular short-term returns. Gerald Cy's Manhattan Fund gained attention for rapid trading and concentrated holdings. Fred Carr's Enterprise Fund pursued similar strategies. These managers became celebrities, profiled in magazines, and sought after by investors who wanted to participate in their success. Performance chasing became common, with money flowing to whichever fund had produced the best recent returns. The Nifty 50 stocks dominated institutional portfolios during the late 1960s and early 1970s. These were large, well-known companies with strong brands and consistent earnings growth. Coca-Cola, IBM, McDonald's, Polaroid, Xerox, among others. Institutional investors believed these stocks were so superior that price was almost irrelevant. They could be bought at any valuation and held indefinitely because their earnings growth would eventually justify any price paid. This philosophy worked until it didn't. When earnings growth slowed or disappointed expectations, the high valuations collapsed. Polaroid, which traded above $140 in 1972, fell below $50 by 1974. Computer technology began transforming market infrastructure during the 1960s. The back offices of brokerage firms, which processed trades and maintained records, struggled to keep pace with rising volume. The paperwork crisis of 1968-1970 forced the New York Stock Exchange to close on Wednesdays to allow firms to catch up on processing. Some smaller brokerages failed, unable to manage the operational complexity. The solution involved computerizing clearing and settlement functions. The Depository Trust Company, established in 1973, immobilized stock certificates by holding them centrally rather than requiring physical delivery for each trade. This reduced the movement of paper and enabled electronic record keeping. NASDAQ, the National Association of Securities Dealers Automated Quotation System, launched in February 1971 as the first electronic stock market. Unlike the New York Stock Exchange's physical trading floor, where specialists matched buyers and sellers, NASDAQ operated through a computer network, displaying dealer quotes. Market makers posted bid and ask prices electronically, and brokers executed trades by contacting dealers directly. The system initially handled over-the-counter stocks that didn't meet NYSE listing requirements. These were typically smaller companies, regional banks, and newer enterprises. NASDAQ's electronic structure proved efficient and scalable, establishing a template for future market evolution. May Day, May 1st on 1975, marked the end of fixed commission rates on stock trades. Since the Buttonwood Agreement, brokers had charged minimum commissions set by exchange rules. The SEC, responding to antitrust concerns, mandated negotiated commissions. Established brokerages resisted, arguing that fixed commissions ensured stable markets and prevented destructive competition. The SEC proceeded regardless. When negotiated rates took effect, commissions for large institutional trades fell immediately by 50% or more. Discount brokerages emerged to serve individual investors willing to forego research and advice in exchange for lower costs. Charles Schwab, founded in 1971, expanded rapidly after May Day by offering execution-only services at reduced rates. The 1970s tested the post-war boom's durability. Inflation, which had remained modest through the 1950s and 1960s, accelerated dramatically. The oil embargo of 1973 sent energy prices soaring. Wage and price controls imposed by the Nixon administration failed to contain inflation and created distortions. The term stagflation entered the economic vocabulary, describing the combination of stagnant growth and rising prices. Traditional economic theory suggested this combination shouldn't occur. If demand was weak enough to produce stagnation, prices should fall. If inflation was rising, demand must be strong, and growth should follow. Reality defied theory. The stock market responded poorly to this environment. Corporate earnings grew nominally, but, adjusted for inflation, showed little real growth. High inflation drove interest rates higher, making bonds more attractive relative to stocks. The Dow Jones reached 1,051 in January 1973, fell to 577 by December 1974, recovered to the low 1,000s, and then traded sideways for the remainder of the decade. By 1982, the Dow still traded below the 1,000 level it had first reached in 1966. 16 years with essentially no price appreciation left many investors disillusioned. Bond markets experienced unprecedented volatility during this period. Interest rates, which had been relatively stable for decades, swung wildly as inflation expectations shifted. Long-term Treasury bonds, considered the safest investments, declined in value as rates rose. Investors who had purchased 30-year bonds yielding 5% in the 1960s saw those bonds trade at steep discounts when prevailing rates exceeded 10% in the late 1970s. The term bond vigilantes emerged to describe investors who would sell bonds aggressively in response to policies they perceived as inflationary, forcing rates higher and imposing discipline on policymakers. Money market funds, a financial innovation of the 1970s, provided an alternative to bank deposits. Banks faced Regulation Q, which capped interest rates they could pay on deposits. When market interest rates exceeded these caps, savers had no way to earn competitive returns on cash through bank accounts. Money market funds purchased short-term debt securities, commercial paper, and treasury bills that yielded market rates, and they allowed investors to redeem shares at any time. This provided bank-like liquidity with higher returns. Assets in money market funds grew from essentially zero in 1971 to over $200 billion by 1980. Institutional investors came to dominate trading volume. In 1950, individuals accounted for approximately 90% of stock trading. By 1980, institutions, pension funds, mutual funds, insurance companies generated approximately 70% of volume. This shift had profound implications. Institutional traders dealt in large blocks of stock, negotiated directly with each other, and demanded sophisticated execution services. Individual investors, while still numerous, became less important to Wall Street's business model. Brokerage research focused increasingly on institutional clients who generated substantial commission revenue rather than retail customers with small accounts. Technology continued advancing through the 1970s despite the difficult market environment. Computers handled more of the routine processing, from trade execution to account statements. Electronic communications networks began linking brokerages, enabling faster information flow. The infrastructure being built would support the explosion in trading volume that would characterize later decades. Warren Buffett emerged during this period as an investor whose approach contradicted prevailing trends. While many managers chased growth stocks and traded actively, Buffett focused on buying undervalued companies with strong competitive positions and holding them indefinitely. His vehicle, Berkshire Hathaway, originally a failing textile manufacturer, became an investment company under his control in the 1960s. Through the 1970s, while the broad market struggled, Berkshire's portfolio of insurance companies and wholly owned businesses generated consistent returns. Buffett's success during a difficult decade established his reputation and validated value investing as a viable strategy. John Bogle founded Vanguard in 1975 and launched the first index investment trust in 1976, the first index mutual fund available to retail investors. Bogle's thesis was simple. Most active managers failed to beat market averages after fees, so why not simply replicate the market at minimal cost? The first index fund raised only $11 million initially and was dismissed by much of the industry as guaranteeing mediocrity. The concept would eventually transform asset management, but adoption was slow initially. By 1980, Wall Street looked nothing like the clubby world of the 1950s. Institutions dominated trading. Computers processed transactions that once required armies of clerks. Commissions had fallen dramatically. The market itself had languished for over a decade, yet the infrastructure was being built for what would become the greatest bull market in history. What was needed was a catalyst. That catalyst arrived in the form of a new political philosophy, a new technology, and a new appetite for debt. The 1980s on Wall Street were fundamentally about leverage. Michael Milken's junk bonds made debt cheap and plentiful, enabling corporate raiders to target companies that had seemed untouchable, and in the process creating and destroying fortunes with unprecedented speed. Leverage had always existed in financial markets, but the 1980s elevated it to a systematic strategy. Companies that generated modest cash flows could be acquired with borrowed money, restructured, and either sold at profits or stripped of assets to repay the debt. The technique worked brilliantly during boom times and catastrophically when conditions turned. Paul Volcker's appointment as Federal Reserve Chairman in August 1979 marked a turning point in the inflation battle. Volcker believed that inflation, which had exceeded 13%, required drastic action. The Fed raised interest rates aggressively, with the federal funds rate reaching 20% by mid-1981. This induced a severe recession. Unemployment exceeded 10%. Industries dependent on credit, housing, and automobiles particularly, collapsed. The pain was intentional. Volcker understood that breaking inflation required crushing demand until wages and prices stopped rising. The strategy worked. Inflation fell from 13.5% in 1980 to 3.2% by 1983. The stock market bottomed on August 16, 1982, with the Dow Jones at 777. Interest rates had begun declining from their peaks as inflation moderated. Corporate profits, depressed during the recession, were positioned to recover. Investors who had avoided stocks during the stagnant 1970s began returning cautiously. What started as a modest rally became a sustained bull market. The Dow crossed 1,000 in late 1982, reached 1,500 by 1985, and approached 2,000 by 1987. The gains reflected both economic recovery and expanding valuation multiples as investors regained confidence. The Reagan administration's deregulatory philosophy aligned with Wall Street's interests. Airlines, trucking, telecommunications, and financial services faced reduced regulatory constraints. The philosophy held that markets allocated resources more efficiently than government planners, and that competition benefited consumers. In financial services, this meant relaxing restrictions on interstate banking, permitting new activities, and generally encouraging innovation. Glass-Steagall remained law, but interpretations became more flexible as regulators approved activities that approached the boundary between commercial and investment banking. Michael Milken, working from Drexel Burnham Lambert's Beverly Hills office, revolutionized corporate finance through high-yield bonds. These securities, also known as junk bonds, carried higher interest rates than investment-grade debt to compensate for greater default risk. Milken recognized that the risk premium exceeded the actual default rates, creating opportunity for investors willing to analyze credits carefully. He built a network of buyers, savings and loans, insurance companies, mutual funds who trusted his judgment and would purchase the bonds he underwrote. Junk bonds financed companies that couldn't access traditional capital markets. Growing firms with leveraged balance sheets, companies emerging from bankruptcy, and businesses in industries viewed skeptically by conservative lenders all found capital through Milken's network. More controversially, junk bonds enabled hostile takeovers. A corporate raider could raise hundreds of millions or even billions of dollars by issuing junk bonds, use those funds to acquire a target company, and then repay the bonds from the target's cash flows or asset sales. This was financial engineering on an unprecedented scale. Corporate raiders emerged as dominant figures. Carl Icahn targeted undervalued companies, purchased stakes, and pressured management to unlock value through restructuring or sale. T. Boone Pickens focused on oil companies, arguing that many traded below the value of their reserves. Ron Perelman built a conglomerate through leveraged acquisitions financed by junk bonds. These raiders presented themselves as shareholder activists fighting entrenched management, and in some cases that characterization was accurate. Inefficient conglomerates were broken up, underperforming assets were sold, and shareholders received premiums when companies were acquired. In other cases, raiders extracted wealth through greenmail payments or asset stripping. Greenmail, simply put, was legalized extortion. A raider would accumulate a stake in a company and threaten a hostile takeover. Management, fearing loss of control, would offer to repurchase the raider's shares at a premium to the market price in exchange for an agreement not to pursue the takeover. The raider profited handsomely for going away. Other shareholders received nothing. The practice was legal but widely criticised as undermining the market for corporate control. Hostile takeovers dominated headlines. Gulf Oil, one of the largest oil companies, received a hostile bid from T. Boone Pickens Mesa Petroleum in 1983. Gulf's management sought a white knight and eventually merged with Chevron for $13.2 billion. Phillips Petroleum faced a similar assault and defended itself through a leveraged recapitalization that left the company deeply indebted but independent. TWA was acquired by Carly Khan in 1985 in a transaction that loaded the airline with debt it struggled to service. The RJR Nabisco leveraged buyout in 1988 became emblematic of the era's excess. Kohlberg Kravis Roberts, a private equity firm specializing in LBOs, acquired the food and tobacco conglomerate for $25 billion, the largest corporate acquisition to that point. The transaction was financed primarily with debt, including substantial junk bond issuance. KKR's strategy involved improving operations, selling peripheral assets, and eventually taking the company public again at a profit. The deal generated enormous fees for investment banks, lawyers, and advisors. It also demonstrated that no company, regardless of size, was immune to takeover if raiders could raise sufficient capital. Defensive measures proliferated as companies sought to protect themselves from hostile bids. Poison pills, formerly known as shareholder rights plans, made acquisitions prohibitively expensive by granting existing shareholders rights to purchase additional shares at discounts if an acquirer crossed specified ownership thresholds. Staggered boards prevented raiders from gaining control quickly by requiring multiple years to elect a majority of directors. Golden parachutes provided executives with substantial payments if they lost their positions following a takeover, increasing the acquisition cost. The stock market boom continued through 1987. The Dow reached 2,122 on August 25, 1987, more than triple the 1982 low. Trading volume had expanded enormously. Daily volume regularly exceeded 200 million shares, compared to 50 million in the early 1980s. New financial instruments emerged. Stock index futures, which allowed investors to bet on market direction without purchasing individual stocks, traded actively. Portfolio insurance strategies, which used computer programs to automatically sell futures contracts when markets declined, gained popularity among institutional investors as a method to limit downside risk. October 19, 1987, Black Monday, brought the most severe single-day decline in stock market history. The Dow fell 508 points, 22.6%, on volume of 604 million shares. The crash began overseas, with markets in Hong Kong and Europe declining sharply before US trading opened. When New York opened, selling overwhelmed the system immediately. Portfolio insurance strategies designed to protect against moderate declines amplified the crash by generating massive sell orders in futures markets. As futures prices fell below cash market prices, arbitrageurs sold stocks to buy futures, transmitting the selling pressure from futures to the stock market. The mechanics of the crash revealed structural vulnerabilities. The NYSE's specialist system, which relied on individual traders to maintain orderly markets in assigned stocks, broke down under the selling pressure. Specialists lacked capital to absorb the volume of shares being sold. Many stocks opened late or stopped trading entirely. The disconnect between futures markets in Chicago and stock markets in New York created opportunities for arbitrage, but also confusion about true prices. Circuit breakers did not exist. Trading continued throughout the day without pause. The Federal Reserve responded immediately. Chairman Alan Greenspan, who had taken office only weeks earlier, issued a brief statement affirming the Fed's readiness to provide liquidity. The New York Fed contacted major banks and directed them to continue lending to securities firms, regardless of the collateral value of securities holdings. This prevented a cascade of failures among brokerages that might have occurred if banks had pulled credit lines. The market stabilized within days and recovered much of the loss within months. The Brady Commission, appointed to investigate the crash, concluded that portfolio insurance and futures cash arbitrage had amplified the decline, but that no single factor had caused it. The Commission recommended circuit breakers to halt trading during extreme declines, allowing time for order imbalances to clear. It also suggested unifying the regulation of stocks and futures markets, which were overseen by different agencies with inconsistent rules. Some recommendations were implemented, others were not. While the market boom continued, insider trading scandals revealed systematic abuse. Dennis Levine, a managing director at Drexel Burnham Lambert, had traded on confidential information about corporate transactions for years, accumulating $12.6 million in illegal profits. His arrest in May 1986 led him to cooperate with prosecutors. Levine implicated Ivan Boesky, a prominent arbitrager who specialized in merger situations. Boesky had cultivated sources inside investment banks and corporations who provided advance information about deals. Boesky agreed to cooperate in November 1986, paying $100 million in fines and accepting a prison sentence. His cooperation implicated others, including Martin Siegel, an investment banker at Kidder Peabody, who admitted passing inside information to Boesky in exchange for cash payments. The investigation eventually focused on Michael Milken and Drexel Burnham Lambert. Prosecutors, led by Rudy Giuliani, the U.S. Attorney for the Southern District of New York, alleged that Milken had engaged in various illegal activities including insider trading, stock manipulation, and securities fraud. Milken's case differed from the others. His activities occurred in the junk bond market, where determining what constituted insider information was complex. Much of the case involved arcane securities law violations rather than straightforward insider trading. Drexel Burnham Lambert, facing indictment under RICO statutes that would have allowed prosecutors to seize assets, agreed to plead guilty to 6 felonies and pay $650 million in fines. Milken initially fought the charges but eventually pleaded guilty to 6 counts of securities violations in 1990. He was sentenced to 10 years in prison, later reduced to 2 years served, and paid $600 million in fines and restitution. Milken's compensation had been extraordinary, even by Wall Street standards. In 1987, he earned approximately $550 million, primarily from Drexel's junk bond operation. This sum dwarfed the compensation of corporate CEOs and other Wall Street figures. Whether Milken's legal violations warranted his punishment remained debated. Supporters argued that junk bonds were legitimate financial innovation and that prosecutorial overreach had destroyed valuable market mechanisms. Critics contended that Milken had operated outside legal boundaries and that his downfall was appropriate. Drexel Burnham Lambert filed for bankruptcy in February 1990, unable to survive without Milken and burdened by legal liabilities. The firm had been among Wall Street's most profitable in the 1980s. Its collapse demonstrated that success built on questionable practices was fragile. The junk bond market contracted sharply after Drexel's failure, with issuance falling by more than 50%. The savings and loan crisis, which reached its peak in the late 1980s and early 1990s, had connections to the junk bond boom. Many S&Ls, deregulated in the early 1980s and permitted to invest in riskier assets, purchased junk bonds from Drexel. When the bonds declined in value or defaulted, the S&Ls faced insolvency. The federal government's bailout of failed S&Ls eventually cost taxpayers over $100 billion. The crisis had multiple causes, but junk bond investments contributed to many failures. The 1980s ended with Wall Street's reputation again tarnished. Milken would go to prison. Drexel would collapse. The junk bond market would nearly disappear for several years. The insider trading scandals revealed that illegal activity had been widespread at the industry's highest levels. The market itself recovered remarkably quickly from the 1987 crash, and the bull market resumed within months. The techniques pioneered in the 1980s, leveraged buyouts, hostile takeovers, activist investing, would become permanent features of corporate finance, though pursued with somewhat more caution in succeeding years. As the 1990s began, few observers would have predicted that the greatest speculative mania in market history was just beginning. The dot-com bubble represented a collision between genuine technological revolution and age-old speculative excess. The internet was real. The business models were often not. Distinguishing between the two proved difficult, at least until it became obvious. Investors who had lived through previous manias should have recognized the pattern: the new technology, the transformational claims, the suspension of traditional valuation methods, the inevitable collapse. Yet each generation appears required to learn these lessons firsthand. The personal computer revolution of the early 1990s created the foundation for internet speculation. Microsoft Windows and Intel processors had become dominant standards. Computers spread from offices into homes, priced affordably enough for middle-class families. These machines initially served limited purposes: word processing, spreadsheets, games, but they established installed bases of users who would eventually want connectivity. When the internet became accessible to consumers rather than just academics and researchers, millions of computers were ready to connect. Netscape's initial public offering on August 9, 1995, marks the beginning of Internet mania. The company had developed a web browser that made navigating the internet easier than previous text-based systems. Netscape Navigator dominated the browser market, though it faced emerging competition from Microsoft's Internet Explorer. The company had minimal revenue and no profits. Traditional valuation metrics suggested caution. The market responded differently. Netscape's shares, offered at $28, opened at $70 and closed the first day at $58.25, valuing the company at over $2 billion. The message was clear: internet companies operated under different rules. Venture capital flooded Silicon Valley. Firms that had focused on semiconductors, software, and biotechnology redirected capital toward internet startups. The calculus was straightforward. If a tiny percentage of investments produced companies like Netscape, the returns would overwhelm losses on the failures. Competition among venture firms intensified. Entrepreneurs with plausible business plans and relevant experience could raise millions in seed funding with minimal difficulty. Those with successful prior exits could raise tens of millions for their next ventures, sometimes with only PowerPoint presentations. The IPO market exploded. Companies that previously would have remained private until achieving profitability now went public within months of launching. The typical path involved venture funding, rapid growth funded by continued losses, and an IPO while momentum was strongest. Profitability was deferred to the future, aftermarket. Dominance had been established. First-day pops became routine. Shares would double or triple on opening day, rewarding venture investors who had purchased at lower prices and creating fortunes for employees who had received stock options. Valuation metrics shifted from earnings to potential. Since internet companies generally had no earnings, analysts invented new measures. Eyeballs counted how many users visited a website. Clicks measured engagement. Page views quantified attention. Revenue, even if the company lost money on every transaction, was celebrated as evidence of market acceptance. These metrics had logic if one believed that internet companies were building valuable networks that would eventually generate profits once scale was achieved. Amazon's Jeff Bezos explicitly argued this position, prioritizing growth over profits and using each dollar of revenue to fund expansion. Day trading emerged as a phenomenon among individual investors. Online brokerages like E-Trade and Ameritrade enabled anyone with a computer to trade stocks from home. Real-time quotas, once available only to professionals, became accessible to retail investors. Chat rooms and message boards allowed traders to exchange ideas, tips, and rumors. Some individuals quit jobs to trade full-time, convinced they could generate better returns than professionals. The most active day traders executed dozens or hundreds of trades daily, profiting from small price movements amplified by leverage. Nasdaq, which had launched in 1971 as a market for smaller companies, became the primary exchange for internet stocks. The Nasdaq Composite Index, which had traded around 500 in the early 1990s, crossed 1,000 in 1995, reached 2,000 by 1998, and approached 3,000 by late 1999. Technology stocks, internet companies particularly, dominated the index. Their weightings increased as market capitalizations expanded, creating a feedback loop. As prices rose, the stocks represented larger portions of the index. As the index rose, funds tracking it purchased more of the expensive stocks, pushing prices higher still. Y2K fears paradoxically contributed to the boom. Concerns that computer systems would fail when dates rolled from 1999 to 2000 drove massive spending on technology upgrades. Corporations purchased new hardware and software, hired programmers to fix legacy code, and generally invested heavily in information technology. This spending boosted revenues for technology companies, which then reported growth that seemed to justify elevated stock prices. When Y2K passed without significant problems, the spending surge ended, removing a source of revenue growth just as valuations were reaching extremes. Pets.com became the symbol of absurd valuations. The company sold pet supplies online, a business with razor-thin margins even in traditional retail. Pets.com spent heavily on marketing, including a $2 million advertisement during the Super Bowl, while losing money on most transactions due to shipping costs exceeding product margins. The company raised $82.5 million in an IPO in February 2000. 9 months later, it liquidated, having burned through essentially all of its capital. The sock puppet mascot from its advertisements became more famous than the company's brief existence. Similar failures abounded. Webvan promised grocery delivery, raising over $800 million to build warehouses and logistics networks in multiple cities before establishing that the business model worked in any single location. Cosmo.com delivered videos, snacks, and other items within an hour in urban areas, charging no delivery fees and thus losing money on every order. eToys raised $166 million in an IPO, briefly achieved a market capitalization exceeding that of Toys R Us, and then collapsed when it became apparent that selling toys online at low margins while competing with established retailers was unprofitable. The parallel telecom bubble received less attention, but involved larger amounts of capital. Telecommunications companies, convinced that internet traffic would grow exponentially, invested hundreds of billions in fiber optic networks. Multiple companies laid fiber along the same routes, creating massive overcapacity. The equipment manufacturers, Nortel, Lucent, Cisco, sold hardware to these telecom companies, reporting revenue growth that appeared sustainable. When the telecom companies ran out of capital and stopped ordering equipment, the manufacturers' revenues collapsed. The Nasdaq Composite reached its peak of 5,048.62 on March 10, 2000. What triggered the reversal remains debated. No single event caused the bubble to burst, instead a combination of factors: rising interest rates, the end of Y2K spending, the absence of plausible acquirers for unprofitable companies, gradually shifted sentiment. Investors who had willingly suspended disbelief began asking uncomfortable questions about when profitability might arrive. Companies that had gone public at high valuations faced pressure to justify those prices with results. The decline was rapid and severe. The Nasdaq fell to 3,227 by May 2000, a decline of 36% in 2 months. A rally through the summer provided false hope that the correction was complete. The decline resumed in September and continued for over 2 years. By October 2002, the Nasdaq traded at 114.11, having lost 78% from its peak. Individual internet stocks performed even worse. Many fell 90 to 99%. Hundreds of companies went bankrupt entirely, erasing all shareholder value. Accounting scandals that emerged from the wreckage were more disturbing than the internet company failures. Enron, an energy trading company that had reinvented itself as a technology-enabled marketplace, had reported consistent earnings growth through the late 1990s. In reality, the company had used complex off-balance sheet structures to hide losses and inflate profits. When the schemes collapsed in 2001, Enron filed for bankruptcy in what was then the largest corporate failure in US history. Arthur Andersen, Enron's auditor and one of the Big Five accounting firms, was convicted of obstruction of justice for destroying documents related to the audit. WorldCom, a telecommunications company that had grown through aggressive acquisitions, had improperly capitalized operating expenses as capital investments, inflating earnings by billions of dollars. When the fraud was revealed in 2002, WorldCom filed for bankruptcy with $104 billion in assets, surpassing Enron as the largest bankruptcy. CAO Bernard Ebbers was eventually sentenced to 25 years in prison. Tyco International, an industrial conglomerate, disclosed that CEO Dennis Kozlowski and CFO Mark Swartz had stolen hundreds of millions through unauthorized bonuses and fraudulent stock sales. The case revealed corporate governance failures and a board that had provided minimal oversight of executives. These weren't internet startups run by inexperienced entrepreneurs. These were established corporations. Enron and WorldCom had been included in the S&P 500 that had systematically deceived investors and regulators. The Sarbanes-Oxley Act, passed in July 2002, imposed new requirements on public companies. CEOs and CFOs were required to personally certify the accuracy of financial statements, accepting criminal liability for false certifications. Companies were required to establish internal controls over financial reporting and have those controls audited. Audit committees were required to be composed of independent directors with financial expertise. The legislation aimed to prevent future accounting scandals by increasing personal accountability and strengthening oversight mechanisms. The compliance costs associated with Sarbanes-Oxley were substantial. Smaller public companies particularly struggled with the expense of documenting and auditing internal controls. Some companies went private rather than bear the costs. Others remained private longer before going public. The IPO market, which had been extraordinarily active during the bubble, contracted sharply. Whether this was primarily due to Sarbanes-Oxley or simply the aftermath of the bubble's collapse remained debated. Conflicts of interest among Wall Street analysts received scrutiny. Research analysts at investment banks, supposedly providing objective analysis, had been compensating for supporting investment banking deals. Henry Blodgett at Merrill Lynch had published positive research on internet stocks while privately calling them worthless in emails. Jack Grubman at Salomon Smith Barney had promoted telecommunications stocks, maintaining buy ratings even as companies approached bankruptcy to support the firm's investment banking relationships. Both analysts reached settlements with regulators involving fines and lifetime bans from the securities industry. The revelations about analyst conflicts led to regulations requiring separation between research and investment banking operations. Analysts could no longer be compensated based on investment banking revenue. Their communications with banking colleagues were restricted. Whether these reforms genuinely eliminated conflicts or simply drove them underground was unclear. The structural problem that research was expensive to produce and investment banking was how firms recouped costs persisted. Venture capital funding collapsed from over $100 billion in 2000 to approximately $20 billion in 2002. Venture firms that had raised large funds during the boom struggled to invest capital in an environment where exits through IPOs or acquisitions had become nearly impossible. Many funds would eventually return capital to investors rather than investing it poorly. The venture industry contracted, with fewer firms and smaller fund sizes persisting through the mid-2000s. Yet some companies survived and eventually thrived. Amazon, which had been derided during the bubble for its losses and whose stock fell from $107 to $7, persisted, achieved profitability, and grew into one of the world's largest companies. eBay, the online auction platform, had actual profits throughout the bubble and continued growing afterward. Google, which had operated quietly during the bubble years, went public in 2004 and demonstrated that internet companies could generate enormous profits from advertising. The survivors shared certain characteristics: real revenue, paths to profitability, and management focused on building businesses rather than inflating stock prices. The dot-com bust destroyed the Nasdaq's credibility for years and revealed that fraud extended beyond unprofitable startups to major corporations. Sarbanes-Oxley imposed compliance burdens that made going public less attractive. The IPO market would never fully recover to bubble-era levels. Even as the market digested these failures, however, seeds were being planted for an even larger crisis, this time in housing and credit markets. The next bubble would be harder to identify because it didn't involve risky startups or new technology. It involved the safest asset class in America: residential real estate. The financial crisis of 2007-2009 was, at its core, a crisis of complexity. Mortgages had been sliced, diced, repackaged, and sold so many times that when defaults began rising, no one could determine who owned what or how much it was worth. That uncertainty nearly destroyed the financial system. The opacity was not accidental. It had been engineered deliberately to disperse risk, or so participants believed, but it had instead obscured risk until the system could no longer function. The housing bubble's origins lay in the early 2000s. The Federal Reserve, responding to the 2001 recession and concerns about deflation, reduced interest rates to historically low levels. The federal funds rate fell from 6.5% in 2000 to 1% by 2003, remaining there for a year. Low rates made mortgages cheaper, increasing housing demand. Home prices, which had been rising steadily through the 1990s, accelerated. The Case-Shiller National Home Price Index, which measures prices in major metropolitan areas, rose approximately 120% from 2000 to 2006. Rising prices created a self-reinforcing cycle. Home buyers, convinced that prices would continue rising, stretched to purchase homes they could barely afford, expecting that appreciation would eventually create equity. Lenders, observing that borrowers rarely defaulted when home values were rising, loosened underwriting standards. Appraisers, under pressure from lenders and borrowers to support transactions, provided valuations that justified larger loans. Regulators, believing that market discipline and diversified ownership of mortgage risk had made the system safer, provided minimal oversight. Subprime mortgages, loans to borrowers with weak credit histories or insufficient income documentation, expanded dramatically. These mortgages carried higher interest rates to compensate for greater default risk, though the premium was often insufficient given the actual risk. Subprime originations grew from approximately $150 billion in 2001 to over $600 billion in 2005. Many featured adjustable rates, with low initial teaser rates that would reset higher after 2 or 3 years. Borrowers who could afford the initial payments often could not afford the reset payments, but lenders assumed borrowers would either refinance or sell before the reset occurred. No documentation loans, also known as liar loans, required borrowers to state their income without verification. These loans were ostensibly for self-employed borrowers whose income was difficult to document, but in practice they enabled anyone to claim whatever income was necessary to qualify for a loan. Stated income, stated assets, or SISA loans eliminated verification of both income and assets. The incentives for fraud were obvious and widely exploited. Securitization transformed mortgages from loans held by the originating bank into securities traded globally. The process involved several steps. Mortgage originators, banks, mortgage companies, and brokers made loans to home buyers. These mortgages were sold to investment banks, which pooled thousands of mortgages into mortgage-backed securities or MBS. The MBS were divided into tranches, each with different priority claims on the underlying mortgage payments. Senior tranches received payments first and were rated AAA by credit rating agencies. Junior tranches received payments only after senior tranches were paid in full and carried lower ratings. The theory held that pooling diverse mortgages from different geographic regions would reduce risk through diversification. If some borrowers defaulted, others would continue paying. The senior tranches would remain safe even if default rates rose moderately. This logic worked if defaults were independent and uncorrelated. It failed catastrophically when housing prices declined nationally, causing defaults across all regions simultaneously. Collateralized debt obligations, or CDOs, represented an additional layer of complexity. Investment banks would purchase the lower-rated tranches of multiple MBS, pool them together, and create a new security divided into new tranches. Through this restructuring, 80% or more of the CDO could receive a Type A ratings, even though it was composed entirely of subprime mortgage risk. The rating agencies' models assumed that pooling across different MBS provided diversification, but this assumption was flawed. All subprime MBS faced the same underlying risk: declining home prices. Synthetic CDOs added yet another layer. These securities didn't own actual mortgages or MBS. Instead, they referenced other CDOs through credit default swaps, derivative contracts that paid out if the referenced CDOs defaulted. This allowed investors to bet on housing market outcomes without any actual mortgages being involved. The notional value of synthetic CDOs far exceeded the value of the underlying mortgages, creating leverage on leverage. Credit rating agencies, Moody's, Standard & Poor's, and Fitch played critical roles in enabling the bubble. Issuers paid agencies to rate their securities, creating conflicts of interest. Agencies competed for business by providing favorable ratings. Their models for assessing mortgage securities relied on historical default rates from periods when housing prices had been rising. The models failed to account for what would happen if prices declined nationally, something that hadn't occurred since the Great Depression. The agencies assigned AAA ratings to securities that would later lose 80 or 90% of their value. Investment banks leveraged their balance sheets to amplify returns. Firms operated with leverage ratios of 30 to 1 or higher, meaning that $30 billion in assets were funded with $1 billion in equity and $29 billion in borrowed money. This magnified returns during good times. A 5% return on assets became a 150% return on equity, but it also meant that small losses on assets could eliminate equity entirely. Bear Stearns, Lehman Brothers, Merrill Lynch, and others accumulated large portfolios of mortgage-related securities, financed through short-term borrowing in the repo market. The first cracks appeared in 2007. Home prices had peaked in mid-2006 and begun declining. Subprime mortgages originated in 2005 and 2006 at the peak of loose lending standards and elevated prices, started defaulting at higher rates than expected. Two hedge funds managed by Bear Stearns that invested heavily in subprime mortgage securities failed in July 2007, losing essentially all of their investors' capital. The failures signaled that subprime mortgage securities were experiencing losses even in senior tranches. Credit markets began malfunctioning in August 2007. Asset-backed commercial paper, short-term debt issued by entities holding mortgage securities became difficult to sell as investors grew concerned about underlying asset quality. Money market funds, which had purchased substantial amounts of this paper, faced potential losses. Banks that had provided liquidity backstops to commercial paper programs faced unexpected draws on those commitments. Interbank lending rates spiked as banks became reluctant to lend to each other, uncertain about counterparties' exposures to mortgage losses. Bear Stearns collapsed in March 2008. The firm faced a classic bank run, with creditors and counterparties refusing to roll over short-term funding. Bear's equity was approximately $11 billion, but it had over $400 billion in assets, funded primarily through overnight repo loans. When repo counterparties refused to renew loans, Bear lacked the liquidity to operate. The Federal Reserve arranged for JP Morgan Chase to acquire Bear, providing $29 billion as financing and effectively guaranteeing Bear's obligations to prevent broader panic. The purchase price of $10 per share later raised to $10 from an initial $2 per share, compared to $170 a year earlier. Fannie Mae and Freddie Mac, government-sponsored enterprises that purchased or guaranteed mortgages, faced insolvency by September 2008. These entities owned or guaranteed over $5 trillion in mortgages. Their business model involved borrowing cheaply, based on implicit government backing, and investing in mortgages at slightly higher yields. When mortgage defaults surged and securities values collapsed, their capital proved inadequate. On September 7, 2008, the federal government placed both entities into conservatorship, effectively nationalizing them and guaranteeing their obligations. Lehman Brothers filed for bankruptcy on September 15, 2008, with $639 billion in assets. It was the largest bankruptcy in history to that point. Lehman faced the same liquidity crisis that had destroyed Bear Stearns 6 months earlier. The difference was the government's response. Treasury Secretary Henry Paulson and Fed Chairman Ben Bernanke decided not to arrange a rescue, partly because they lacked legal authority to guarantee Lehman's obligations the way they had guaranteed Bear's, and partly because they believed that allowing a failure would demonstrate that creditors faced risk and reduce moral hazard. The decision to let Lehman fail proved catastrophic. Credit markets froze globally within hours. The commercial paper market, which provided short-term funding for corporations, essentially stopped functioning. Banks refused to lend to each other overnight, even at elevated interest rates. Money market funds faced redemptions as investors panicked. The Reserve Primary Fund, which held Lehman commercial paper, broke the buck, meaning its net asset value fell below $1 per share, triggering redemptions that threatened other money market funds. AIG, American International Group, required a government rescue the following day, September 16, 2008. AIG was an insurance company that had sold credit default swaps, providing insurance against defaults on mortgage securities and CDOs. The company had sold $2.7 trillion notional value of credit default swaps, much of it on mortgage-related securities. As those securities declined in value, AIG's counterparties demanded collateral. AIG lacked sufficient liquid assets to post the required collateral. The Federal Reserve provided an initial $85 billion credit line, eventually expanding to $182 billion to prevent AIG's failure, which would have triggered defaults on swaps held by banks globally. The crisis's intensity during September 2008 cannot be overstated. Each day brought new failures or near failures. Washington Mutual, the largest savings and loan, failed on September 25th and was acquired by JP Morgan. Wachovia, the fourth largest bank, agreed to be acquired by Wells Fargo after facing deposit runs. Morgan Stanley and Goldman Sachs, the two remaining independent investment banks, converted to bank holding companies to access Federal Reserve lending facilities, ending the era of independent investment banks. The Troubled Asset Relief Program, or TARP, authorized $700 billion to purchase troubled mortgage securities from banks. Treasury Secretary Paulson proposed the program in late September 2008 as the crisis intensified. Congress initially rejected the legislation, sending the Dow Jones down nearly 800 points in a single day. A revised version passed on October 3, 2008. The program's implementation shifted from purchasing troubled assets to directly injecting capital into banks through preferred stock purchases, a more efficient method for recapitalizing the financial system. The stock market declined relentlessly through the fall of 2008 and into early 2009. The Dow Jones, which had peaked at 14,164 in October 2007, fell to 6,547 in March 2009, a decline of 54%. Financial stocks performed even worse. Citigroup fell from over $50 to below $1. Bank of America declined from $50 to $3. Many believed major banks would be nationalized. The uncertainty about which institutions would survive prevented any sustained recovery until spring 2009. Bank failures accelerated. From 2008 through 2012, 465 banks failed, most of them smaller regional and community banks that had concentrated portfolios of real estate loans. The FDIC, which insured deposits, arranged for healthy banks to acquire failed institutions, protecting depositors but imposing losses on shareholders and some creditors. Larger banks were deemed too big to fail and received government support rather than being allowed to collapse. The Federal Reserve implemented unprecedented policies. Interest rates were reduced to effectively zero, the zero lower bound. The Fed purchased Treasury securities and mortgage-backed securities directly. Quantitative easing, expanding its balance sheet from under $900 billion before the crisis to over $2 trillion by 2010, and eventually over $4 trillion. The Fed created numerous emergency lending facilities to provide liquidity to money market funds, commercial paper issuers, and various other financial entities. The auto industry bailout extended TARP beyond financial institutions. General Motors and Chrysler faced bankruptcy in late 2008, having been weakened by years of declining market share, and then pushed to the brink by the credit crisis and collapsing demand. The Treasury provided approximately $80 billion in loans and equity to restructure both companies through managed bankruptcies, protecting jobs, and preventing the collapse of the auto supply chain. The American Recovery and Reinvestment Act, the stimulus package passed in February 2009, provided approximately $800 billion in government spending and tax cuts to support the economy. The unemployment rate, which had been 4.4% in 2007, reached 10% in 2009. GDP declined for 5 consecutive quarters. The recession was the worst since the Great Depression, though government intervention prevented it from reaching Depression-era severity. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in July 2010, created the most comprehensive financial regulation since the 1930s. The legislation established the Consumer Financial Protection Bureau to regulate mortgages and consumer credit products. It imposed the Volcker Rule, restricting banks from proprietary trading. It required large banks to undergo annual stress tests, assessing their resilience to economic shocks. It created resolution authority, allowing regulators to wind down failing systemically important institutions. It mandated that derivatives be traded through central clearinghouses rather than over the counter. The crisis's causes were multiple and interconnected. Low interest rates encouraged risk-taking. Deregulation had permitted commercial banks to engage in activities previously restricted. Compensation structures rewarded short-term profits without accounting for long-term risks. Credit rating agencies failed to assess securities accurately. Regulators missed or ignored warning signs. Borrowers took on debts they couldn't afford, and lenders enabled them. Each participant acted in ways that seemed rational individually, but were collectively destructive. The financial crisis came closer to destroying the global financial system than any event since the Great Depression. Only massive government intervention, TARP, Fed lending facilities, bank recapitalizations, stimulus spending prevented total collapse. Wall Street survived, though its reputation, already damaged by dot-com scandals, was now in ruins. Lehman's bankruptcy and AIG's bailout revealed that the largest, most sophisticated financial institutions had taken risks they didn't understand and couldn't manage. The question was whether the regulatory response would prevent the next crisis. The post-crisis era would bring unprecedented Federal Reserve intervention, new regulations, and eventually, the longest, bull markets in American history. Wall Street today operates in a world that would be unrecognizable to traders from even 30 years ago. Computers execute most trades in microseconds. Passive funds dominate active managers. Interest rates spent a decade near zero, and trading commissions have fallen to, quite literally, zero. The transformation reflects technological change, regulatory reform, and the Federal Reserve's evolution into a permanent market support mechanism. Whether this represents progress or simply new forms of fragility remains an open question. The Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law on July 23, 2010, created the regulatory framework for post-crisis finance. The legislation ran to over 2,300 pages and required regulators to write hundreds of implementing rules. The Volcker Rule, named for former Fed Chairman Paul Volcker, prohibited banks from proprietary trading, defined as trading for their own profit rather than on behalf of clients. The distinction between proprietary trading and legitimate market making proved difficult to define in practice, leading to years of regulatory negotiation about implementation details. Stress tests became annual exercises for the largest banks. Regulators would specify hypothetical scenarios, severe recessions, market crashes, oil price shocks, and banks would calculate their projected losses and capital levels. Banks that failed stress tests faced restrictions on dividends and stock buybacks until they raised additional capital. The process forced banks to maintain detailed models of their risk exposures and provided regulators with insight into vulnerabilities. Whether the tests actually measured resilience or simply measured banks' ability to satisfy regulatory models was debated. The Federal Reserve's response to the crisis extended far beyond traditional monetary policy. Quantitative easing, the purchase of Treasury securities and mortgage-backed securities to inject money into the economy, expanded the Fed's balance sheet from approximately $900 billion in 2007 to over $4 trillion by 2015. QE1, QE2, and QE3 represented successive rounds of asset purchases intended to lower long-term interest rates, support asset prices, and encourage lending. Critics argued that QE primarily inflated asset prices, benefiting wealthy investors while doing little for the broader economy. Supporters contended that preventing deflation and economic collapse justified the policies. Zero interest rate policy, or ZIRP, persisted from December 2008 through December 2015. The federal funds rate remained between 0 and 0.25% for 7 years, the longest period of near zero rates in US history. Low rates reduced borrowing costs for corporations and homeowners, but compressed returns for savers and pension funds. Retirees who had planned to live on interest from safe bonds found yields insufficient to meet expenses. Pension funds, needing higher returns to fund obligations, took greater risks by increasing allocations to stocks, private equity, and alternative investments. The stock market recovery from the 2009 low was initially tentative. The Dow Jones reached 10,000 in late 2009, having recovered roughly half the losses from the peak. Concerns about European debt crises, US fiscal debates, and China's growth slowing periodically interrupted the advance. Each pullback brought predictions that the rally was unsustainable and another crisis was imminent. Each time the market recovered and continued higher. By 2013, the Dow had exceeded its 2007 peak. By 2017, it crossed 20,000. In 2020, before the COVID crash, it approached 30,000. The bull market from March 2009 to February 2020, approximately 11 years, became the longest in US history. The Dow rose from 6,547 to 29,551, a gain of 351%. The rally was not smooth. Corrections of 10 to 20% occurred periodically, but the trend was unmistakably upward. Corporate profits grew steadily as the economy recovered. Tax cuts passed in 2017 boosted after-tax earnings. Stock buybacks, in which companies repurchased their own shares, reduced share counts and increased earnings per share mechanically. Passive investing transformed asset management. Index funds, which simply replicate market indexes rather than attempting to select superior stocks, grew from a niche product to the dominant investment vehicle. By 2019, passive funds held more assets than active funds for the first time. The shift reflected growing recognition that most active managers failed to outperform indexes after fees. Why pay 1% annual fees for underperformance when an index fund charged 0.05% and matched the market? Vanguard, the pioneer of index investing, grew to manage over $7 trillion in assets, making it one of the world's largest asset managers. BlackRock, through its iShares ETF platform, managed over $9 trillion. These firms accumulated enormous voting power in corporate elections simply by virtue of owning broad market indexes. When a small number of index fund providers own 20 or 25% of every major corporation, their influence over corporate governance is substantial, even if they rarely vote against management. Exchange-traded funds, or ETFs, proliferated beyond simple index replication. ETFs tracking commodities, currencies, specific sectors, and investment strategies emerged. Leveraged ETFs used derivatives to provide 2 or 3 times the daily return of an underlying index. Inverse ETFs bet against indexes declining. By 2020, over 7,000 ETFs existed globally, holding more than $10 trillion in assets. The vehicles provided liquidity and diversification, but also enabled speculation and short-term trading that contradicted the buy and hold philosophy traditionally associated with index investing. High-frequency trading, also known as HFT, came to account for 50 to 70% of US equity trading volume. These strategies used computers to execute thousands or millions of trades per second, profiting from tiny price discrepancies. HFT firms competed on speed, locating servers physically close to exchange computers and investing in faster data connections to gain microsecond advantages. The social value of this activity was debatable. Proponents argued that HFT provided liquidity and tightened bid-ask spreads. Critics contended that it was essentially a tax on ordinary investors, with HFT firms front-running orders by detecting them microseconds earlier. Flash crashes, sudden extreme price movements lasting seconds or minutes before reversal, became periodic occurrences. On May 6, 2010, the Dow Jones fell nearly 1,000 points in minutes before recovering most of the loss within minutes. The crash was triggered by a large automated sell order that overwhelmed buy-side liquidity, causing algorithms to withdraw from the market, which amplified the decline. Circuit breakers were modified after the incident to pause trading in individual stocks experiencing extreme moves, but concerns about market fragility persisted. Commission-free trading became standard in 2019 when major brokerages eliminated commissions on stock trades. Charles Schwab announced free trading in October 2019, and competitors immediately matched. The move eliminated a revenue source that had sustained the brokerage industry since the Buttonwood Agreement. How would brokerages profit if they charged nothing for execution? The answer was payment for order flow. Market makers paid brokerages for the right to execute their clients' trades, earning profits from bid-ask spreads. This created potential conflicts of interest, as brokerages might route orders to market makers, offering the highest payments rather than the best execution. Robinhood, a mobile-first brokerage founded in 2013, epitomized commission-free trading and democratized access to markets. The platform enabled fractional share purchases, allowing investors with limited capital to buy portions of expensive stocks. It also featured a gamified interface with confetti animations celebrating trades. Critics argued that Robinhood encouraged excessive trading by unsophisticated investors who treated investing as entertainment. The platform's role in the meme stock phenomenon would intensify these concerns. The SPAC boom of 2020-2021 represented another financial innovation of questionable value. Special purpose acquisition companies, also known as blank check companies, went public as shell corporations with no operations. The SPAC would raise capital through an IPO, then search for a private company to acquire within a specified time frame. If a suitable target was found, shareholders would vote on the proposed merger. This structure allowed private companies to go public without traditional IPO roadshows and regulatory scrutiny. Over 600 SPACs went public in 2020-2021, raising over $160 billion. Most performed poorly after completing mergers, with many trading well below their IPO prices within months. Cryptocurrency emerged as an alternative asset class, though its relationship to traditional finance remained ambiguous. Bitcoin, created in 2009, reached a market capitalization exceeding $1 trillion during price peaks. Institutional investors, hedge funds, and even some corporations added Bitcoin to their portfolios, treating it as a speculative investment or potential inflation hedge. Wall Street's response was cautious. Some investment banks created cryptocurrency trading desks. Futures contracts on Bitcoin began trading on regulated exchanges, but major banks largely avoided direct holdings, citing regulatory uncertainty and volatility. The meme stock phenomenon in January 2021 demonstrated the power of coordinated retail investor action. GameStop, a struggling video game retailer, had been heavily shorted by hedge funds, betting on its decline. Users of the Reddit forum Wall Street Bets coordinated purchases of GameStop shares and call options, driving the price from $20 to $483 in a matter of weeks. The short squeeze forced hedge funds, covering short positions, to buy shares at elevated prices, amplifying the rise. Melvin Capital, a hedge fund with a large GameStop short position, lost billions and required a capital infusion to avoid failure. Robinhood and other brokerages restricted trading in GameStop and other meme stocks during the peak volatility, allowing only sell orders. The restrictions sparked accusations that brokerages had sided with hedge funds against retail investors. The reality was more prosaic. Clearinghouses had raised collateral requirements for brokerages given the volatility, and Robinhood lacked sufficient capital to meet these requirements without restricting trading. Nevertheless, the incident highlighted tensions between retail investors and Wall Street institutions. The COVID-19 pandemic triggered the fastest bear market in history in March 2020. The Dow Jones fell from 29,551 on February 12th to 18,591 on March 23rd, a decline of 37% in 23 trading days. The market's response to a global pandemic causing economic lockdowns and uncertainty about when normal activity would resume was predictable. What was less predictable was the recovery. The Fed's response was immediate and massive, cutting rates to zero, launching unlimited quantitative easing, and creating new lending facilities to support corporate debt markets. Congress passed multiple fiscal stimulus packages totaling trillions of dollars, including direct payments to households and enhanced unemployment benefits. This combination of monetary and fiscal support stabilized markets. The Dow regained its February 2020 peak by November 2020, just 8 months after the low. By the end of 2021, markets had risen well above pre-pandemic levels despite the pandemic continuing. The disconnect between market performance and economic conditions, with millions unemployed while stock indexes reached records, fueled debates about wealth inequality and the Fed's role in inflating asset prices. ESG investing, focused on environmental, social, and governance factors, grew from a niche concern to a mainstream consideration. Asset managers launched ESG-focused funds. Corporations published sustainability reports. Proxy advisory firms began recommending votes based on ESG criteria. Whether ESG investing represented genuine concern for societal issues or simply marketing remained debated. Some investors believed that companies with strong ESG practices would outperform long-term. Others viewed ESG as activism, disguised as investing, that sacrificed returns for political goals. Private equity and private markets generally grew relative to public markets. The number of publicly traded companies in the US declined from over 7,000 in the late 1990s to approximately 4,000 by 2020. Companies stayed private longer, achieving valuations that once would have triggered IPOs. Uber, Airbnb, and other unicorns, private companies valued at over $1 billion, delayed going public for years. When they finally did IPO, much of their value appreciation had accrued to private investors rather than public market participants. Private equity firms raised enormous funds to acquire public companies and take them private, arguing they could improve operations without quarterly earnings pressures. Direct listings and alternative IPO structures emerged as companies sought to avoid traditional investment banking fees and lock-up periods. Spotify and Slack went public through direct listings, allowing existing shareholders to sell immediately without the company raising new capital or investment banks underwriting the offering. The structures reduced cost but also eliminated the price support and analyst coverage that traditional IPOs provided. Jerome Powell, who became Fed chairman in 2018, continued his predecessor's policies of supporting markets. When markets declined sharply in late 2018, the Fed paused interest rate increases. When the COVID pandemic struck, the Fed's response was immediate and overwhelming. The message was clear. The Fed would not permit severe market declines or financial instability. This implicit put option under markets, the Fed put, encouraged risk-taking. If markets rose, investors profited. If markets fell significantly, the Fed would intervene to support them. This asymmetry subsidized speculation and created moral hazard. Modern Wall Street looks little like its predecessors. Trading happens in microseconds, executed by algorithms in data centers. Passive funds hold more assets than active managers, reducing price discovery and concentrating voting power. Retail investors coordinate on social media to move stock prices, and the Federal Reserve stands ready to intervene at any sign of trouble, having learned from 2008 that preventing collapse takes priority over moral hazard concerns. Whether this system is more stable or simply more complex remains an open question. The crisis averted in March 2020 demonstrated the Fed's willingness and ability to act decisively. But it also demonstrated that markets had become dependent on such interventions. The infrastructure is sophisticated, the trading is faster, and the regulations are more comprehensive than ever before. Yet each innovation creates new risks, and each attempt to eliminate old vulnerabilities opens new ones. The next crisis will arrive eventually. Its form and the system's response will determine whether the decades of reform and innovation since 2008 have created genuine resilience or simply postponed reckoning. Wall Street today operates in a world that would be unrecognizable to traders from even 30 years ago. Computers execute most trades in microseconds. Passive funds dominate active managers. Interest rates spent a decade near zero, and trading commissions have fallen to, quite literally, zero. The transformation reflects technological change, regulatory reform, and the Federal Reserve's evolution into a permanent market support mechanism. Whether this represents progress or simply new forms of fragility remains an open question. The Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law on July 21, 2010, created the regulatory framework for post-crisis finance. The legislation ran to over 2,300 pages and required regulators to write hundreds of implementing rules. The Volcker Rule, named for former Fed Chairman Paul Volcker, prohibited banks from proprietary trading, defined as trading for their own profit rather than on behalf of clients. The distinction between proprietary trading and legitimate market making proved difficult to define in practice, leading to years of regulatory negotiation about implementation details. Stress tests became annual exercises for the largest banks. Regulators would specify hypothetical scenarios, severe recessions, market crashes, oil price shocks, and banks would calculate their projected losses and capital levels. Banks that failed stress tests faced restrictions on dividends and stock buybacks until they raised additional capital. The process forced banks to maintain detailed models of their risk exposures and provided regulators with insight into vulnerabilities. Whether the tests actually measured resilience or simply measured banks' ability to satisfy regulatory models was debated. The Federal Reserve's response to the crisis extended far beyond traditional monetary policy. Quantitative easing, the purchase of treasury securities and mortgage-backed securities to inject money into the economy, expanded the Fed's balance sheet from approximately $900 billion in 2007 to over $4 trillion by 2015. QE1, QE2, and QE3 represented successive rounds of asset purchases intended to lower long-term interest rates, support asset prices, and encourage lending. Critics argued that QE primarily inflated asset prices, benefiting wealthy investors while doing little for the broader economy. Supporters contended that preventing deflation and economic collapse justified the policies. Zero interest rate policy, or ZIRP, persisted from December 2008 through December 2015. The federal funds rate remained between 0 and 0.25% for 7 years, the longest period of near-zero rates in US history. Low rates reduced borrowing costs for corporations and homeowners, but compressed returns for savers and pension funds. Retirees who had planned to live on interest from safe bonds found yields insufficient to meet expenses. Pension funds, needing higher returns to fund obligations, took greater risks by increasing allocations to stocks, private equity, and alternative investments. The stock market recovery from the 2009 low was initially tentative. The Dow Jones reached 10,000 in late 2009, having recovered roughly half the losses from the peak. Concerns about European debt crises, US fiscal debates, and China's growth slowing periodically interrupted the advance. Each pullback brought predictions that the rally was unsustainable and another crisis was imminent. Each time the market recovered and continued higher. By 2013, the Dow had exceeded its 2007 peak. By 2017, it crossed 20,000. In 2020, before the COVID crash, it approached 30,000. The bull market from March 2009 to February 2020, approximately 11 years, became the longest in US history. The Dow rose from 6,547 to 29,551, a gain of 351%. The rally was not smooth. Corrections of 10 to 20% occurred periodically, but the trend was unmistakably upward. Corporate profits grew steadily as the economy recovered. Tax cuts passed in 2017 boosted after-tax earnings. Stock buybacks, in which companies repurchased their own shares, reduced share counts, and increased earnings per share mechanically. Passive investing transformed asset management. Index funds, which simply replicate market indexes rather than attempting to select superior stocks, grew from a niche product to the dominant investment vehicle. By 2019, passive funds held more assets than active funds for the first time. The shift reflected growing recognition that most active managers failed to outperform indexes after fees. Why pay 1% annual fees for underperformance when an index fund charged 0.05% and matched the market? Vanguard, the pioneer of index investing, grew to manage over $7 trillion in assets, making it one of the world's largest asset managers. BlackRock, through its iShares ETF platform, managed over $9 trillion. These firms accumulated enormous voting power in corporate elections simply by virtue of owning broad market indexes. When a small number of index fund providers own 20 or 25% of every major corporation, their influence over corporate governance is substantial, even if they rarely vote against management. Exchange-traded funds, or ETFs, proliferated beyond simple index replication. ETFs tracking commodities, currencies, specific sectors, and investment strategies emerged. Leveraged ETFs used derivatives to provide 2 or 3 times the daily return of an underlying index. Inverse ETFs bet against indexes declining. By 2020, over 7,000 ETFs existed globally, holding more than $10 trillion assets. The vehicles provided liquidity and diversification, but also enabled speculation and short-term trading that contradicted the buy and hold philosophy traditionally associated with index investing. High-frequency trading, also known as HFT, came to account for 50 to 70% of US equity trading volume. These strategies used computers to execute thousands or millions of trades per second, profiting from tiny price discrepancies. HFT firms competed on speed, locating servers physically close to exchange computers and investing in faster data connections to gain microsecond advantages. The social value of this activity was debatable. Proponents argued that HFT provided liquidity and tightened bid-ask spreads. Critics contended that it was essentially a tax on ordinary investors, with HFT firms front-running orders by detecting them microseconds earlier. Flash crashes, sudden extreme price movements, lasting seconds or minutes before reversal, became periodic occurrences. On May 6, 2010, the Dow Jones fell nearly 1,000 points in minutes before recovering most of the loss within minutes. The crash was triggered by a large automated sell order that overwhelmed buy-side liquidity, causing algorithms to withdraw from the market, which amplified the decline. Circuit breakers were modified after the incident to pause trading in individual stocks experiencing extreme moves, but concerns about market fragility persisted. Commission-free trading became standard in 2019 when major brokerages eliminated commissions on stock trades. Charles Schwab announced free trading in October 2019, and competitors immediately matched. The move eliminated a revenue source that had sustained the brokerage industry since the Buttonwood Agreement. How would brokerages profit if they charged nothing for execution? The answer was payment for order flow. Market makers paid brokerages for the right to execute their clients' trades, earning profits from bid-ask spreads. This created potential conflicts of interest, as brokerages might route orders to market makers, offering the highest payments rather than the best execution. Robinhood, a mobile-first brokerage founded in 2013, epitomized commission-free trading and democratized access to markets. The platform enabled fractional share purchases, allowing investors with limited capital to buy portions of expensive stocks. It also featured a gamified interface with confetti animations celebrating trades. Critics argued that Robinhood encouraged excessive trading by unsophisticated investors who treated investing as entertainment. The platform's role in the meme stock phenomenon would intensify these concerns. The SPAC boom of 2020-2021 represented another financial innovation of questionable value. Special purpose acquisition companies, also known as blank check companies, went public as shell corporations with no operations. The SPAC would raise capital through an IPO, then search for a private company to acquire within a specified time frame. If a suitable target was found, shareholders would vote on the proposed merger. This structure allowed private companies to go public without traditional IPO roadshows and regulatory scrutiny. Over 600 SPACs went public in 2021, raising over $160 billion. Most performed poorly after completing mergers, with many trading well below their IPO prices within months. Cryptocurrency emerged as an alternative asset class, though its relationship to traditional finance remained ambiguous. Bitcoin, created in 2009, reached a market capitalization exceeding $1 trillion during price peaks. Institutional investors, hedge funds, and even some corporations added Bitcoin to their portfolios, treating it as a speculative investment or potential inflation hedge. Wall Street's response was cautious. Some investment banks created cryptocurrency trading desks. Futures contracts on Bitcoin began trading on regulated exchanges, but major banks largely avoided direct holdings, citing regulatory uncertainty and volatility. The meme stock phenomenon in January 2021 demonstrated the power of coordinated retail investor action. GameStop, a struggling video game retailer, had been heavily shorted by hedge funds, betting on its decline. Users of the Reddit forum Wall Street Bets coordinated purchases of GameStop shares and call options, driving the price from $20 to $483 in a matter of weeks. The short squeeze forced hedge funds covering short positions to buy shares at elevated prices, amplifying the rise. Melvin Capital, a hedge fund with a large GameStop short position, lost billions and required a capital infusion to avoid failure. Robinhood and other brokerages restricted trading in GameStop and other meme stocks during the peak volatility, allowing only sell orders. The restrictions sparked accusations that brokerages had sided with hedge funds against retail investors. The reality was more prosaic. Clearinghouses had raised collateral requirements for brokerages given the volatility, and Robinhood lacked sufficient capital to meet these requirements without restricting trading. Nevertheless, the incident highlighted tensions between retail investors and Wall Street institutions. The COVID-19 pandemic triggered the fastest bear market in history in March 2020. The Dow Jones fell from 29,551 on February 12th to 18,591 on March 23rd, a decline of 37% in 23 trading days. The market's response to a global pandemic causing economic lockdowns and uncertainty about when normal activity would resume was predictable. What was less predictable was the recovery. The Fed's response was immediate and massive, cutting rates to zero, launching unlimited quantitative easing, and creating new lending facilities to support corporate debt markets. Congress passed multiple fiscal stimulus packages totaling trillions of dollars, including direct payments to households and enhanced unemployment benefits. This combination of monetary and fiscal support stabilized markets. The Dow regained its February 2020 peak by November 2020, just 8 months after the low. By the end of 2021, markets had risen well above pre-pandemic levels, despite the pandemic continuing. The disconnect between market performance and economic conditions, with millions unemployed while stock indexes reached records, fueled debates about wealth inequality and the Fed's role in inflating asset prices. ESG investing, focused on environmental, social, and governance factors, grew from a niche concern to a mainstream consideration. Asset managers launched ESG-focused funds. Corporations published sustainability reports. Proxy advisory firms began recommending votes based on ESG criteria. Whether ESG investing represented genuine concern for societal issues or simply marketing remained debated. Some investors believed that companies with strong ESG practices would outperform long-term. Others viewed ESG as activism, disguised as investing that sacrificed returns for political goals. Private equity and private markets generally grew relative to public markets. The number of publicly traded companies in the US declined from over 7,000 in the late 1990s to approximately 4,000 by 2020. Companies stayed private longer, achieving valuations that once would have triggered IPOs. Uber, Airbnb, and other unicorns, private companies valued at over $1 billion, delayed going public for years. When they finally did IPO, much of their value appreciation had accrued to private investors rather than public market participants. Private equity firms raised enormous funds to acquire public companies and take them private, arguing they could improve operations without quarterly earnings pressures. Direct listings and alternative IPO structures emerged as companies sought to avoid traditional investment banking fees and lock-up periods. Spotify and Slack went public through direct listings, allowing existing shareholders to sell immediately without the company raising new capital or investment banks underwriting the offering. The structures reduced costs but also eliminated the price support and analyst coverage that traditional IPOs provided. Jerome Powell, who became Fed chairman in 2018, continued his predecessor's policies of supporting markets. When markets declined sharply in late 2018, the Fed paused interest rate increases. When the COVID pandemic struck, the Fed's response was immediate and overwhelming. The message was clear: the Fed would not permit severe market declines or financial instability. This implicit put option under markets, the Fed put, encouraged risk-taking. If markets rose, investors profited. If markets fell significantly, the Fed would intervene to support them. This asymmetry subsidized speculation and created moral hazard. Modern Wall Street looks little like its predecessors. Trading happens in microseconds, executed by algorithms in data centers. Passive funds hold more assets than active managers, reducing price discovery and concentrating voting power. Retail investors coordinate on social media to move stock prices, and the Federal Reserve stands ready to intervene at any sign of trouble, having learned from 2008 that preventing collapse takes priority over moral hazard concerns. Whether this system is more stable or simply more complex remains an open question. The crisis averted in March 2020 demonstrated the Fed's willingness and ability to act decisively, but it also demonstrated that markets had become dependent on such interventions. The infrastructure is sophisticated, the trading is faster, and the regulations are more comprehensive than ever before. Yet each innovation creates new risks, and each attempt to eliminate old vulnerabilities opens new ones. The next crisis will arrive eventually. Its form and the system's response will determine whether the decades of reform and innovation since 2008 have created genuine resilience or simply postponed reckoning.